Good morning and welcome to all the participants for the day 8 of the Advanced GST Certificate course. Today's first topic will be GST refunds, inverted duty, export, SCZ, 100% EOU, and excess payment. The speaker for the day will be CA Arjun, and the expert comments will be delivered by CA AKBAR sir. A brief introduction about CA Arjun. He qualified as a chartered accountant in 2017 and currently working at Bengaluru branch of Hirgange Associates, assisting partner CA Mahadev in audit wing. His core competence have been in the area of GST, FTP and customs. Further, he has work experience in implementing UAE VAT. He has written a booklet on beneficial schemes under FTP 2015 and 20, published by Hirgange Academy, and assisted and contributed to the book Handbook on GST Audit, published by KSCAA, authored by CA Rajesh Kumar sir and CA.ASHISH Chaudhary sir, partners of Hirgange Associates. Also a member of powerful study circle Akshara at Hirgange Associates, a regular and an active participant in online forum Tax Management India. A brief introduction about today's expert, sir. Expert comment. CA Akbar, sir. He have qualified chartered accountant in year 2009. Presently engaged in representation services before SESTAT and quasi judicial authorities, and also reads pre and post GST refund compliance. He mentors CS and CWA students in the subject of financial management and indirect taxes. He has co-authored Service Tax Made Simple, published by CASPUDARJUNAN. He is an active speaker in various topics of GST, organized by various forums, and also lead training sessions for various CA firms in the area of GST, service tax, and central excise. He has also contributed articles to various online forums. With this brief introduction, I request CA Arjun sir to kindly take forward the session. Thank you, sir.
Yeah, thank you, Ajay, for your warm introduction and welcome. Good morning to all participants. So today in our session for next 2 hours, we are going to deal on the advanced issues with which are either resolved or unresolved, and I will be sharing my thought process on those issues and what can be the legal grounds a rational taxpayer can take on those issues. With reference to refund, first we will have a general introduction on the refund in the indirect tax regime. The dictionary meaning of refund in general refers to repay, give back, restore, reimburse, restitution of sum or money. So in general, refund is something which is being repaid by the government to the taxpayer. So initially there will be an activity of payment of tax by the taxpayer, which is going to be repaid by the government. It is not neither a concession or an incentive scheme which is proposed in the taxation laws. One more thing with regard to refund. Refund is a special provision implemented in the taxation law, which will be having its own machineries of assessment and adjudication. So per se, a taxpayer cannot claim a refund as his right to be claimed from the government unless there is a specific provision in the law. One exception to this right concept for claiming refund is where the levy is an unconstitutional levy, where it is not backed up by any authority of law under Article 265 of Constitution of India. A person can claim the refund as a right because the revenue doesn't have constitutional authority to levy taxes. In those cases, it will become a right of the taxpayers. In all other cases, unless otherwise specifically provided in the law, refund cannot be initiated or refund can't be demanded by the taxpayer from the revenue. So it is clear that refund provisions should be instituted in the law for a taxpayer to claim it. And one additional refund provision in relation to refund provisions, it is always accompanied by the recovery provisions and both are complementary in nature. So if you see any taxation law, along with the refund provisions will be always accompanied along with the recovery provisions. So whenever the tax law talks about recovery, they would also talk about the refund provisions which they want to repay to the taxpayers in specific scenarios. Under GST, the relevant provisions of refund under CGST Act relates from section 54 to 58, and relevant rules covers from rule 89 to 97A. So we are going to deal with these provisions along with section 16 of IGST Act and section 20 of IGST Act. So these are all the relevant provisions of the law which we are going to deal today. Under section 54, there are several scenarios provided under GST law where a taxpayer can demand refund from the revenue. So refund can be either two types: refund of input tax credit or refund of the tax paid through cash or credit. So once, if a taxpayer wants to claim a refund of the accumulated input tax credit which is lying in this electronic cash ledger, there are only two scenarios where a taxpayer can claim the refund. Those are the zero rated supplies where the person has been made under LUT without payment of tax. The second scenario is inverted duty structure. The term inverted duty structure is not defined in the law, it is a trade parlance. The term used in the GST law is accumulation of input tax credit on account of rate of tax on inputs being higher than the rate of output supplies. So they have been defined as a sentence. So for the easy reference, we have termed it as an inverted duty structure. So only in these two cases, we can claim a refund of input tax credit from the government. In other cases, where are the cases where we can claim the refund of taxes paid by the registered persons. So cases where the tax has been paid under zero rated supply like exports and supplies to SEZs, and also can cover the deemed exports, which we will be covering in the subsequent deliberation, and merchant exports. The second scenario where a tax can be claimed is where you have paid a wrong type of tax and where you want to pay the proper type of tax. The government will refund initially the wrong type of tax and then you can make payment of the proper taxes. The next scenario, which I said, which is general in all law and which can be claimed as a rate for the taxpayer, is where the tax, interest or any other amount paid by the taxpayer which is not backed by Article 265 of Constitution of India, where there is no authority for the law to levy tax, the taxpayer gets automatic right to claim it as a refund. The next residual entry is wherever the government notify any class of applicants on the recommendation of council, they would notify such person to claim as an eligible person to claim a refund. At present, they have not specified any eligible person or such class of person under section 54. However, there is a specific section 55 where the government has notified some specialized agencies and specific class of persons where they can claim the refund of input tax credit or tax paid by them. So with this brief introduction, first we will go and discuss on the concept and the issues under refund for zero rated supplies. Under zero rated supply, first thing which we need to be clear on the concept, zero rated supply does not specify a rate of tax. It is a category of supply which is provided under section 16 of IGST Act. So for dealing with zero rated supply, we have to refer the provisions of both IGST Act and CGST Act. Section 16 of IGST Act specifies supplies of goods or services, namely export of goods or services or both, or supply of goods or services to a special economic zone or developer of special economic zone unit. They cover these two transactions as zero rated supply. So once you are exporting goods or services or just you are supplying to an SEZ unit or a developer of SEZ unit, the transaction will be covered under zero rated category. So the zero rated supply is a category of supply which covers these two scenarios, two type of transactions. However, the rate of tax remains same, which will be covered under notification 11/2017 in case of services and 1/2017 in case of goods. The rate of tax does not change for such transaction. However, the category of such supplies would be treated as zero rated supply. So, what is the benefit of this zero rated supply? Once that transaction is covered under zero rated supply, for such transaction, the supplier can opt for refund. There, the law provides two options for claiming refund under zero rated supplies under section 16(3). A registered person making zero rated supply can claim refund of accumulated input tax credit if he is making supply under a letter of undertaking or bond subject to such conditions, safeguard, and procedure as may be prescribed. This is one option which is given to the supplier for claiming refund of accumulated input tax credit. The other option, alternate option provided to supplier of zero rated supply are he can supply goods or services with payment of tax and claim the refund of such integrated tax paid subject to safeguard procedures and conditions as may be prescribed. So the supplier of zero rated supply can opt either for refund of accumulated input tax credit or integrated tax paid. Now in this case, with reference to special economic zone, as we said, for the purpose of zero rated supply, if you are supplying to a SEZ unit or developer of an SEZ unit, that activity would be covered under zero rated supply. However, for the purpose of claiming refund in relation to supply to SEZ, there is one more condition which has to be read together, which is provided under rules, GST rules, stating such transaction should be for authorized operation of SEZ. So you can claim refund when you are providing supplies to an SEZ only when it is for the authorized operation for SEZ. Even though for zero rated condition, there is no condition for zero rated supply, there is no condition provided such as it should be for authorized operation. However, when it comes to claiming of refund for the supply provided to SEZ, you have to also satisfy the condition that such supplies are for the authorized operation of such SEZ unit. As we said, when under section 16(3) of IGST Act, where you are going to claim refund for zero rated supply, it has provided that conditions, safeguard, and procedures may be prescribed in section 16(3) of IGST Act. Wherever there's a word as prescribed is provided under the Act, the law provides that there will be a rules prescribed or the procedure prescribed for such subject matter what is covered under such as prescribed. So here under section 24 of IGST Act, section 24 of IGST Act provides power to make rules for the central government for whatever provisions related to IGST Act. So the government has powers to prescribe the safeguard conditions and procedures under section 24 of IGST Act, where they need to prescribe under IGST rules. We would cover the issue under this scenario in subsequent slides, but I request the participants to remember that the conditions, safeguard, and procedures to claim refund for zero rated supply are provided under section 16(3) of IGST Act, which should be prescribed under rules under section 24 of IGST Act. Next, with this brief context on such zero rated supply, now we can deal with the issues which are either resolved or yet to be resolved by the government in relation to zero rated supply. The first issue which is going to be discussed is period for claiming refund. Under the CGST Act or IGST Act, including rules, there have not been prescribed any periodic time, for example, periodic limit for claiming refund to club the periods. So as per the law, you can claim refund within 2 years from the relevant day for whatsoever period you are claiming under your application. However, circular number 125 2044/2019 provided such a restriction, stating that you cannot club 2 months from different financial year in a single refund application. Doubts arise in the taxpayers that when the law the act or rule doesn't prescribe for the such restrictions that the months from different financial cannot be clubbed, the circular issued by the department provided such restrictions. So the taxpayer has raised this issue in the case of Mrs. Pidambara books in Delhi High Court, where the court has examined the issue and stated that when there is no restriction provided in the law, the circular cannot operate beyond the provisions of the law and provide an additional restrictions, such kind of restriction for clubbing both financial years. So in this regard, Circular 135 has been issued by the department to clarify that the conditions prescribed in the previous Circular 125, it is ultra vires, and there cannot be any such restriction on clubbing of such financial years, and the taxpayers can file refund clubbing the months of different financial years in the single application. Even though the circular has clarified the stand of the government, we are yet to see the change in portal in this regard. So even though the law has clarified its stance, the portal would not allow even today to club the different months of different financial years. So we need to check only if the portal allows, we can file in practically. However, the law makes it clear that you can club periods from different financial year. And including the Circular 125, they have also prescribed that all the proceedings for refund to a maximum possible extent would be dealt with online transactions. So even now the portal has started issuing show cause notices and getting replies through portal, through online, so that to achieve maximum transparency in such refund proceedings. The next issue one should always keep in mind is when you are filing refund application for accumulated input tax credit, that is, you have opted for zero rated supply without payment of tax under LUT. So filing of LUT is one of the conditions for making zero rated supply without payment of tax. However, when a taxpayer misses to file LUT, however, he has satisfied all other conditions of the zero rated supply. That means in case of export of services, he has satisfied all the conditions of export of services, he has realized the foreign currency. However, he has missed to file LUT, or he has filed in a delayed time. After making zero rate supply, we have filed LUT. One of the general principle of law says that, which has been tested in several cases and judicial precedents are available, stating a procedural lapse cannot deny the substantial benefits. I have quoted the case of Mangalore Chemicals and Fertilizers Limited and Formica India versus Collector of Central Excise, where they said the technical lapse or procedural lapse cannot deny the substantial benefit intended by the legislature. So, in case if you have satisfied all the conditions of your export, zero rated supply, and only there is a procedural lapse of non-filing of LUT or delayed filing of LUT, it is clear from the legal precedents that you can still claim the benefit. Also, the circular number 125 makes it clear that the proper officer has his discretion to condone the delay of filing LUT, taking into the facts and circumstances of the case. So the officer has the power to condone the delay of filing LUT. Further, even we have legal decisions and precedents to stick on the stand that just a procedural lapse should not deny the intended benefit of the legislature to the taxpayer. Moving on to the next issue, presently, when a taxpayer is filing refund application either under accumulated refund of accumulated input tax credit, the department is verifying the invoices of availed input tax credit and judging or analyzing the eligibility of such input tax credit. They are issuing deficiency memo or show cause notices based on you have availed ineligible credit for the purpose of refund, so you can't avail the credit. Regarding this issue, I have gone through the provisions and rules of the law, where nowhere in the law states that the officer requires to analyze the eligibility of such input tax credit claimed by the taxpayer as a refund. So here the doubt may arise whether the department is overriding the law through their procedure. If you read the rule 89.2, it says that a statement containing number and date of invoices received during the tax period in case of where the refund pertains to accumulated input tax credit has to be submitted. So we need to submit the statement of input tax credit invoices received during the tax period. However, the department may not have the power to judge or decide upon the eligibility of input tax credit which has been availed by the taxpayer in case of refund provisions. So here a person can challenge the validity of the procedures undertaken by the department. Even though the intention of the revenue is to not provide the erroneous refund, whatever procedure they are following should be properly backed up by the law. The second issue with relating to such accumulated input tax credit refund is presently the department is requiring to match the GSTR 2A the invoices and restricting even the additional 10% or 20% in the respective time limit provided under Rule 36.4. That is, Circular number 135/2020 issued by the department states that the taxpayer cannot claim refund in addition to any invoices reflecting in GSTR 2A. So if you want to claim a refund, such invoices has to be reflected in GSTR 2A. Presently in the industry, the people are challenging the validity of Rule 36.4 itself, stating that when Section 43A of CGST Act, which is yet to be notified, which is waiting for the implementation of new return, you cannot implement the intention of the Act through a rule, through the back way, without the provisions or authority to levy such rule. So even if you challenge, apart from challenging such rule itself, we can also challenge that where there is no mechanism provided in the law, in the rules, to verify the correctness of ITC as per 2A. If the intention of the revenue or government is to do that, we should ask them to amend the rule to add the powers of the officers to verify such eligibility of input tax credit or to match with 2A versus 3B in order to claim refund, so that it is backed up by the law and there will be a specific procedures provided by the law so that the officers can follow. Presently, since there is no specific provisions in the Act or the rules, the officers are following their own method and it has been made a discretionary powers which will provide an option for the officers to harass the taxpayer. And one more issue, after issuance of Circular 135, where it says the refund cannot be provided apart from the input tax credit reflecting in 2A, now presently many of the taxpayers are finding difficulty stating refund on RCM credits, reverse charge mechanism credits, where they have paid through their self-invoice. It is clear that when you are making payment under RCM through raising your own self-invoice, such credit would not be reflected in GSTR 2A because there is no registered supplier to upload his invoice in your name. In this case, by literal reading of the Circular 135, the officer started bearing the RCM credits to the taxpayers to claim as a refund. So by this ground, we can get into the celebrated judgment of Ratan Melting and Wire Industries, where the Supreme Court itself said that the circulars are binding on the officers and the circular cannot override the provisions of the law. If the circular overrides the provisions of the law, even the departmental officer can challenge the validity of circular. It is not that circular is mandatory to be followed even for the officers. So we being a taxpayer, circulars are being an instruction provided to the implementing officers of the law. When the circular ultra wires the provisions of the law, you can always challenge. The main irony of Circular 135 is the first part of Circular 135 itself states regarding such ultra wiring effects of circular, which is dealt in Pidambara books, and said circular cannot override the law. in the same circular, the second part, they have provided clarifications which are ultra wearing and overriding the provisions of the law, which is the irony of such circular. So the validity of circular 135 itself can be questioned, and can remove the challenge the legal validity to the extent where it is ultra wearing the provisions of the law. So the matching concept of GST Act 2A versus 3B for the purpose of refund can be questioned, and also you may also challenge the procedure which is undertaken by the officers presently to verify the eligibility and restricting the refund based on their own judgment whether the credit is eligible or ineligible at the time of filing refund. Why I am saying it is not within the purview, because section 50, in between the section 54 to 58, read with rule 89 to 97A of CGST rules, there is no powers or no procedures prescribed under the law for the officers to verify or analyze the eligibility of credit. If they want to analyze or restrict the ineligible credit, they have to follow the procedure prescribed under 73 or 74 of CGST Act. If they implement all the powers of 73 and 74 to restrict on this erroneous refund or ineligible credit availed without issuing following the procedures prescribed under 73 and 74, makes such provisions redundant. Under refund provisions, the departmental officer has to just check the statement of input tax credit invoices which is being provided by the assessee, which is matching to the claim made in the GSTR 3B, and he has to issue refund. In case of erroneous refund or ineligible credit claimed by the assessee, in such refund claim has to be demanded back, or such test has to be made only under the powers prescribed under section 73 or 74 of CGST Act. So one may challenge the procedure presently followed by the departmental officers when issuing refund. The next issue with related to accumulated credit is the recent amendment made to Rule 89(4)(c) of CGST rules, where it has said that when you are making export of goods, it is not relating to services. Such exports are only related to goods. When you are making export of goods under LUT, the valuation has to be restricted to the 1.5 times of the domestic live goods. So there, the discussion happened in the industry whether such restriction in valuation is has legal validity in the provisions of eyes of the law, whether it can be challenged. So prima facie, per se, you cannot challenge such restriction, because section 15(5) of CGST Act provides the power to government to prescribe the valuation method in case of specific class of transactions. So per se, one may find difficult to challenge such restrictions. However, we can challenge the restriction provided in 89(4)(c) based on the stand it is vague. It does not provide the clear picture, or there is no machinery provided for calculation of such 1.5 times. For example, the rule says plain that when a person has both domestic supply and export supply of goods, the value in case of export cannot exceed the value of 1.5 times of the same goods supplied by the supplier in the domestic market. Now the question may arise that what if I am exporting the same kind of goods but with different customization to the customer, or where the quality differs from the domestic goods and the export goods? Can this 1.5 times can be a reasonable for a reasonable restriction? So based on such vagueness or clarity required in the law, one may challenge the newly amended rule 89(4)(c), where there is a restriction provided for 1.5 times of the domestic goods. As I said, I would read out the section 15(5) for your easy reference, where it says, the value notwithstanding anything contained in subsection 1 or 4 of section 15 of CGST Act, the value of such supplies as may be notified by the government on recommendation of council shall be determined in such manner as may be prescribed. So, and we can also, the revenue can also take a stand that the restriction provided in 89(4)(c), the powers has been conferred from section 15(5) of CGST. However, the taxpayer can take a stand to legally challenge such a rule, stating it does not provide a manner to calculate such valuation when there is a differentiation in the facts and circumstances, like specific customization or differentiation in the quality of product. So with that, we can challenge the recent amendment where there is a restriction of 1.5 times in relation to valuation on export of goods made under NMT. Now we have covered almost all the issues under refund of accumulated input tax credit under zero rated supply. Now we can move on to issues which have been dealing with refund of integrated taxes paid under zero rated supply. When it comes to with payment of tax zero rated supply, you have to bifurcate the transaction into export of goods and others. Because when you are making export of goods with payment of tax, you doesn't require to file a specific refund application. The shipping bill filed by you would be treated as shipping bill filed by you, and GSTR 1 filed by you will be treated as a refund application. Then the refund will be processed automatically by syncing the details from GSTN portal with the IceGate. So there was an issue in initial period of time which is being reduced gradually for the time being, which is differences of details between IceGate and GSTN portal. Initial period, there was a huge amount of refund has been stuck because there was no proper data flow between GSTN portal and IceGate. And even where there is a proper data flow, there was a little clerical errors like invoice number or the invoice value between GST portal and IceGate were not matching due to clerical mistakes made by the taxpayers. So this was made into notice of the department, customs department, where they have come up with an alternative mechanism stating wherever there are differences or due to clerical errors in relation to invoices under GSTN portal and IceGate, the taxpayer can provide the list of proper values, providing a reconciliation between the GST invoices and shipping bill detail in a specific format provided under Circular 5/2018 Customs dated 23rd February 2018, and you can submit such form to your proper customs officer who would rectify such issues in IceGate and process your refund. If the error pertains to GST portal, you can amend the GST returns, and when it is pertaining to shipping bill details, as provided in alternative mechanism under Customs Circular 5/2018, you can submit the details along with the reconciliation of invoices under GST and shipping bill to the proper customs officer so that your refund can be processed. Next, when it comes to export of services or supplies to SEZ with payment of tax, still you may require to file a separate refund application. And when it comes to filing of refund application with the tax department, under Circular 125, as I said before, even for refund on integrated tax paid, the department requires in the circular from the taxpayer to submit the GSTR 2A details and the details of input tax credit availed by the taxpayer. Now, two issues arises when it comes to with payment of tax refund. Under with payment of tax, we can utilize the transitional credit also for the purpose of payment of tax and claim it as a refund. However, such transitional credit would not be reflected in GSTR 2A. So presently, the department is denying the refund, stating that the ITC input tax credit reflected in 2A is lesser, whereas you have paid the tax more because we would have utilized the transitional credit to make the payment, and they are denying the refund. Is it legally valid? As I said, the law does not even provide the requirement of matching with 2A even for refund of accumulated input tax credit. And when you are claiming the refund of taxes paid, the restriction provided by the circular for matching with 2A is purely ultra-varying the provisions of the law, which one may have to legally challenge in the court of law. The one more issue with the refund on integrated tax paid, not only they are asking submission of GST or 2A, they are even asking for 2A reconciliation with the ITC, where the refund is been claimed for output tax paid. I don't know what is the logic behind where the department is still verifying the input tax credit. The logic which I can give for an example, when you are purchasing a rice, you can always check on the quality of the rice which you are purchasing. However, when you are purchasing dosa or idli which has been made through the rice after processing, you can't still go and verify the quality of the rice used in that food item. So you can verify the quality of the food item, but not the ingredients which has been used in the food item. This can be a normal logic which one can think of where it comes to refund of integrated tax. When a person is applying refund of the tax paid him, that requirement, the restrictions provided, conditions provided by the department on verification of input tax credit for the payment of such taxes can be questioned. I am not telling that the department doesn't have the powers to verify such input tax credit. I am trying to put upon the argument that for the purpose of refund, under refund provisions of the law, the law doesn't provide the powers to the officers to verify such correctness. The departmental officer has always power to verify the eligibility of input tax credit and correctness of the input tax credit, but however, under different provisions of the law, they can scrutinize your return, they can issue show cause notice under section 73 or 74, and they can demand if you have claimed ineligible credit. But such powers does not arise when you have applied for the refund provision, refund purpose, because the refund provisions under GST law doesn't provide such powers. In the introduction itself, I have covered that refund provisions under a taxation law is a specific nature or a special nature which has its own assessment and adjudication machinery. So in such machinery under GST law, they have not prescribed the powers of the officer to verify the eligibility of input tax credit while providing refund of either accumulated input tax credit or the integrated tax paid under zero rated category. The next issue relate to with payment of tax export comes with Rule 9610. Rule 9610 of CGST rule, whether it has its legal validity. So in my introduction part, I have specifically stressed upon the fact that for the purpose of providing refund of zero rated supply, the law can provide safeguard, conditions and procedures which is being prescribed under IGST Act, Section 16 of IGST Act. Wherever the Act says as may be prescribed, the Act is providing power to make rules in such context. So Section 24 of IGST Act has its own power to specify such safeguard, restrictions, conditions and procedures for the purpose of providing such refund. However, there is no rule prescribed under IGST rules in relation to such refund. Then now we'll come to Section 20 of IGST Act. Section 20 of IGST Act states that just a minute. Section 20 of IGST Act states that subject to the provisions of IGST Act, the provisions of CGST Act in relation to so and so will mutatis mutandis apply to IGST Act. What it says is the provisions of CGST Act in relation to specific heading, which includes even refund, will mutatis mutandis applicable to IGST Act. Even the CGST rules will be mutatis mutandis applicable to IGST Act based on the notification provided under IGST rules. What I am trying to say is, where the provisions of IGST Act provides such powers to prescribe the safeguard procedures and restrictions, prescribing such conditions through a CGST rules, whether it is a legally valid, whether there is an interrelation between the provisions of IGST Act and CGST rules. Section 20 of IGST Act says that the provisions of CGST would mutatis mutandis applicable to IGST Act also. But where the powers to prescribe the conditions is being provided under Section 16 of IGST Act, and power to prescribe such restrictions which should have been dealt with Section 24 of IGST Act now has been wrongly issued under CGST rules. So now we will come to the part of CGST provisions. CGST rule gets powers from Section 164 of CGST Act. Wherever the Act provides the context to prescribe procedures, under Section 164 of CGST Act, the government have the power to prescribe such rules. Now we will come to Section 54 of CGST Act, which predominantly deals with refund provisions. So Section 54 of CGST Act provides the power to government to issue refund subject to the form and manner as may be prescribed. So Section 54 of CGST Act provides the powers to the government to prescribe the form and manner. We are clear cut, we can say that the form does not include any conditions, restrictions, so on. So now we can come to the next word, manner, whether the government can interpret the word manner in a such a way that even the restriction prescribed under 9610 can be fitted under the provisions of manner, because that is the only option which the revenue may try to put it up to legalize the validity of the rule 9610. So to what extent the term manner can be extended? In general meaning, Black Law's dictionary, the term manner has been defined as a way, mode, or method of doing anything or a mode of proceeding in case of any case of situation. So by this understanding, we can get into a conclusion, get in an inference that manner prescribes a positive action. Manners provides a method of doing something, a mode of doing something. Manner does not prescribe a restriction, a negative meaning that the method should not be done like this, or the manner would not provide any restriction to any proceeding. However, the term manner provides a procedure of doing something, a mode of doing something. So through this interpretation, and even in the case of Ashnew Drums Private Limited versus Maharashtra State Finance Corporation, the term manner was discussed by Supreme Court, where it says that manner means a method of procedure, or to provide for an appeal is to provide for a mode of procedure. So the term manner is a term which gives mode of procedure to doing something. So just by procedure, they cannot provide the restriction from stopping doing anything by the taxpayer. So now we will come to Rule 9610. This is the basic concept because of which we are challenging the legality of Rule 9610. Even assuming but not admitting, even if we accept the fact it is legal, that 9610, the provisions prescribe such rule is being legal, we can also challenge on other grounds of 9610, where we can say the 9610 does not provide clear picture whether such restriction applies supplier wise or transaction wise. The doubt arises because a person may have thousands of transactions of export of goods or export of services during a financial year, either in hundreds or thousands, as the case may be. 9610 says if any supplier opts for the exemption provided under notification 78/2017 of customs, which prescribes the EOU exemption, where you can avail the exemption of IGST and BCD under customs. If you have availed such exemption, or it says when you have availed any services from a supplier who opted for merchant export transaction, in that case you cannot opt for this with payment of tax export. So a person having 100 of transaction, and if he indulge in single transaction in the financial year, the Rule 9610 prescribes the restriction of with payment of tax export for the entire financial year. So one may also challenge whether the Rule 9610 applies in a transaction wise or a supplier wise restriction. Normally, logically, it should apply transaction wise. Where I have availed the exemption for in the procurement part, I cannot make the export with payment of tax. Can be one legal stand which one can take, because supplier wise restriction may treat it as an arbitrary restriction provided by the law, which we can challenge based on the constitutional validity. One more thing which we require to discuss in this part is, recently through notification 16/2020, the government has come up with a relaxation to the taxpayers in relation to such restriction, where it says, where a person has availed the exemption of EOU under customs, he can opt for with payment of IGST at the time of import. So if he have made the payment of IGST at the time of import, he is still eligible to make zero rated supply with payment of tax, and he might not be barred by Rule 9610. This is the relaxation provided by the CGST Act through notification 16/2020. However, such relaxation is being prescribed only for EOU, whereas even the merchant exporter transaction has been covered in Rule 9610. They have not provided any relaxation for them. So still one may challenge the Rule 9610. The next issue is, in such notification, I don't think so it is an intentional drafting. They have drafted only in relation to inputs, where an EOU imports for his business with payment of IGST. He may still opt for export with payment of tax. What happens if EOU is importing capital goods? Whether EOU can opt for claiming exemption only for BCD and make payment of IGST Act. By reading out the provisions of the law under both customs and GST, the taxpayer has the power to opt for it, claiming exemption of customs and payment of IGST, because these two levies are arising through two different provisions of the law. So it is always to the option of the assessee to decide upon whether he has to claim the exemption of only customs duty or both customs duty and IGST. So the customs department was denying to claim separate exemption just because of their technical difficulties, and their system was not allowing in their IceGate portal. However, legally, a person has right to avoid the exemption of IGST, and he may opt for payment of IGST so that he can claim credit, and he can still opt for claiming the exemption of BCD. And we can always challenge the validity of 9610, which we have discussed earlier. So we can state that the 9610, in my opinion, the Rule 9610 can be constitutionally challenged for its legality, and the government may struck down, the court may struck down the restriction provided under 9610 due to such legal validity, lacuna in the law. Now we will come to the common issues which pertains both to accumulated ITC refund and integrated tax paid refund. There is a specific rule, new rule amended along with the amendment relaxation provided to Rule 9610. The government has also inserted a Rule 96B for recovery of sanctioned refund. At present, the law in relation to export of goods, the definition of export of goods has been borrowed from customs law, where it says where the goods have been moved outside India, the goods have been taken outside of India, it is treated as export of goods. There is no condition related to realization of consideration with respect to export of goods, whereas for export of services, the definition itself provides that there should be a realization of consideration in foreign currency, convertible foreign currencies. However, where a person opts for export under LUT while signing a letter of undertaking under section 96A, one should always see that there is a condition in LUT stating that you would receive the convertible foreign currency within 12 months from the date of invoice, relevant date. From relevant date, 12 months within, you have to, the taxpayer has to realize the consideration. So the LUT prescribes that condition. So only the exporter of goods with who is making zero rated supply under LUT through the provisions, through the conditions prescribed under LUT would subject to realize the foreign currency consideration. Now, Rule 96B states that whether you are exporting under LUT or with payment of tax, irrespective of that, even for export of goods, the realization of consideration has been made mandatory, which where one can always raise the argument. Rule 96B is overriding the provisions of the Act, where the Act doesn't prescribe any such conditions for export of goods. Now, Rule 96B is prescribing the such conditions for realization of consideration. The second ground which one can take for challenging such Rule 96B is Section 54 of CGST Act provides the power to the rules to prescribe the form and manner for providing refund. It does not prescribe the power to recover the refund. If even the recovery comes within Section 54, then what is the use of Section 83, 80 and 83, where it is specifically provided for recovery of erroneous refunded amount? So here the 96B can also be challenged on the ground that the power to recovery is not being provided under refund provisions. Plus, when the Act does not provide the condition for export of goods to realization of consideration, and Rule 96B had or provides such condition for the purpose of recovery of taxes, we may also take a stand that it is unconstitutional levy. So, where you cannot levy the tax directly, you are indirectly recovering the tax, which will take a color of levy, where you are recovering me the refund provided where I have paid the tax at the time of export, and you are recovering me the refund. It is an indirect way of levying the tax. So one can also challenge stating that it is an unconstitutional levy. Moving on to one more issue. Even if you treat the entire Rule 96B is valid, assuming it is being valid and the department comes with some rationale to make it valid, making amendments in the law, 96B states that once the refund has been recovered from the exporter and the exporter realized the consideration in the extended time period of RBI, he can claim the refund back. So the word used here is you can claim the amount back from the department which has been recovered from you, because 96B states that when the consideration has not been realized within the time limit prescribed under FEMA or RBI in the normal time period, they can recover the tax from the taxpayer along with the interest under Section 50. The 96B states that the procedures will be proceedings will be taken up by Section 73, 74 along with the interest of Section 50. We are challenging the ground that which provides the power to prescribe Rule 96B, which provision of the Act, which section under Section 54 to 58, the refund provisions, provide the powers to the government to prescribe such rules to recover the refund along with the interest when in relation to export of goods where you have not realized the consideration. So the Act does not provide any restriction to with relation to realization of consideration. Through a rule, you are providing such restrictions and you are prescribing the procedure to recover the refund along with the interest. So once I claim back the consideration in the extended period of RBI, so the rule itself provides that the amount recovered can be claimed as a refund back. So the word term use this amount, so we can also infer that once the refund has been recovered along with the interest and the consideration has been realized subsequently, I can claim back from the government along with the refund amount plus the interest amount which has been refunded. You can take that stand if the department has recovered from you and you have subsequently realized the consideration, you have the right, you have the power to claim back that not only the tax which has been recovered, you can also recover the interest which has been recovered from you. The next issue, which is related to which is commonly related to both accumulated ITC refund or integrated tax refund. This is little bit serious issue where at the end of the refund application, the portal is requiring the taxpayer to sign on the declaration, to accept on a declaration which is mandatory in nature, where the taxpayer himself providing a declaration that he has complied with section 16(2)(c) of CGST Act. What is section 16(2)(c) of CGST Act? Section 16(2)(c) provides that the tax collected by the supplier, that means wherever you have received invoices, supplies, and the supplier has charged you tax and you are availing input tax credit, you are declaring to the government that such collected tax has been paid by the supplier either through cash or input tax credit admissible. So the word used by them is input tax credit admissible. So if the supplier has paid the tax, whatever he has collected from you through an ineligible claim of input tax credit made by him, still it will be treated that section 16(2)(c) has not been complied. So through this vicious loop of identification, there cannot be any end. So you cannot verify your supplier's book whether he has paid the tax or not. Even if you paid the tax, you need to verify whether he has paid through cash or input tax credit. If he has paid through input tax credit, you have to verify whether he has paid the tax through admissible input tax credit or ineligible input tax credit. This is the condition prescribed under section 16(2), which is very much draconian and arbitrary without any reasonable condition. You cannot expect a taxpayer to do such impossible conditions. So we are challenging the condition of section 2(c) itself, whereas while filing refund application, the portal is requesting a mandatory declaration from the taxpayer stating that the supplier has complied, that you have complied with section 16(2)(c), which is impossible. A rational taxpayer cannot comply with the condition which has been prescribed in section 2(c) in a normal course of business. So where the condition itself an impossible condition, how the government can get a mandatory declaration from the taxpayer that he has complied with such condition? Can we challenge such declaration as an undue influence from the government? Undue influence has been defined in Indian Contract Act, and section 19A of Contract Act says that wherever the contract has been influenced by the dominant party through an undue influence, it is voidable at the end of the other party. So even though you are accepting such declaration, you can always challenge that it has been obtained through an undue influence. You cannot, the government has obtained the declaration from the exporter because it has been made mandatory. Unless you accept that declaration, you cannot file refund. So you can always take a stand that it is an undue influence made by the government on the taxpayers to get such declaration. The next issue, the exclusion of capital goods, which I have missed in accumulated input tax credit. So section 16 of IGST Act says that you can claim the refund of accumulated input tax credit when you are making export without payment of tax. However, the rule 89 of CGST Act, CGST rule, provides that in the definition of net ITC, it covers only input and input services, and it's not including the capital goods. First of all, what you refer to challenge is, instead of going directly to Article 14 for discrimination of input tax credit in an arbitrary or irrational manner, you first require to challenge that whether there is a power prescribed to rules to exclude such capital goods, where the Act itself says the accumulated input tax credit can be claimed as a refund, which provision provides the power to rule to exclude capital goods. So first you raise the challenge that rules is overriding the law, take the stand of Mrs. Intercontinental Consultant and Technocrats, the judgment of Supreme Court, and take the stand that the rules is overriding the law, and the capital goods cannot be excluded from the net ITC of for the purpose of claiming refund of accumulated ITC. This is also one of the issue relating to accumulated ITC which we need to challenge. The next issue which can be faced by the taxpayers are where the export has been made related to services, where a taxpayer has made export of services for the purpose of evidencing the realization of convertible foreign currency. The law prescribes that you have to submit either FIRC or EBRC. Apart from these two documents, the law does not provide any space for the taxpayers to submit any document. However, from 2016, through circular 4/2016, FEDI prescribed that FIRC cannot be issued by banks where there is a model of advance receipt, like you are receiving the amount in advance, however exporting later, that bank would not issue any FIRC. However, they will issue only the payment advice. When it comes to refund, the law does not prescribe EBRC or FIRC or any other documents. It says only EBRC, FIRCs are qualified documents for the purpose of claiming refund. Where there is a restriction provided in the banking for banking companies for issuing FIRCs, when you are following advance model, the business person, the rational exporter, has to take a call whether he has to change his business model. Instead of receiving in advance, he has to issue invoice first, and then he need to receive the currency consideration from the recipient. However, this may affect the business and affect the working capital flow of the business also. So here, can we try to replicate the stand of the S2L regime in GST regime? I will give you the context of the S2L regime, where previously, for the purpose of claiming SENVAT credit prior to 2005, 7/6/2005, the TR6 challan under customs was not treated as a valid document to claim SENVAT credit. And from 7/6/2005, they have amended the SENVAT credit rules to include even TR6 challan to claim treat it as an eligible document to claim a credit. In case of SL Propack Limited, Tribunal Mumbai, Sestat Mumbai has ruled that the miss out of TR6 challan as an eligible document for claiming credit prior to 7/6/2005 doesn't seem to be an intentional exclusion. It might be a drafting error or something. And since the intention of the law is to provide eligibility of credit of tax paid, even TR6 challan can be treated as an eligible document for claiming the refund. Based on the same stand, and also including the procedural lapse cannot deny the substantial benefit, when you have the payment advice and you can prove that you can get a declaration from the bank that you have received such so and so foreign currency in relation to such transactions, the law should not debar the exporter from claiming the refund. However, as on today, there is a lacuna in the provisions where the provisions only restrict to EBRC and FIRC. So the officer may have power to deny you refund if you are not providing FIRC. It is at his discretion when you are providing declaration from the bank. So the government has to clarify this aspect as soon as possible. Now, Annexure B of Circular 135. Moving on to the next issue, Annexure B of Circular 135 states that at the time of filing refund for the purpose for easy reference of the officer to bifurcate between input service and capital goods, they are requiring to mention the HSN and SAC. We are challenging the classification of such ITC for debarring from refund of such capital goods and so on. So we can challenge the validity of the circular also. And when the supplier itself not liable to mention HSN and SAC in this invoice, whether I need to require whether I require to fill such HSN and SAC details in my application, the circular itself provides that when the supplier itself not liable to mention HSN or SAC, the refund applicant has also not required to mention such details. However, you can challenge the circular validity of requiring such HSN and SAC. The next issue which we are dealing is for the purpose of calculating the time limit when it relates to export of services, the relevant date, the time limit, whether we have to check on invoice basis or application level. So here there is a S12 decision in Span Infotech India Private Limited. The tribunal, larger bench of tribunal, has decided that the time limit will be counted as an application wise, not on invoice or FIRC wise. The next issue presently which in GST we are facing is where the officer is issuing a deficiency memo for refund application filed by you. Once the deficiency memo is issued, presently the GST portal treats such application has never been filed, and when you are replying to such deficiency memo, such application has been treated as new application filed by you. So this has a risk. So as a rational taxpayer, you have to always decide to not to wait for the last day of relevant time limit. So if the time limit is 2 years, try to file after 1 year prior to 1.5 years, because we don't know whether when the department officer will issue deficiency memo. So if you are filing on the last day of the time limit and he issues deficiency memo on 3rd day, so the refund application filed by the taxpayer will be treated as nullified, and you cannot, when you are replying to deficiency memo, your date of application filing will be treated as a new refund application, which is barred by the time limit under GST provision. So it is, as a rational taxpayer, to avoid the litigation and dispute, it is always better to file refund application at earliest and not to wait till the last day of the time limit. However, we have a decision in S12 regime under ARIA Export and Industries. The Delhi High Court has stated that where he has filed a refund application, and when because of some document deficiency there has been a deficiency memo issued by the department, and when he replies, for the purpose of calculating the limitation, you have to take the date of original application filed, even though it is with deficiency. You have to take upon consideration the date of application, refund application filed in original, not the updated refund application. But this is a dispute. For taking this stand, you have to fight with the departmental officer. So in order to avoid such litigation or dispute, it is always recommended to file the refund application at early as possible. The restriction provided to second proviso of 54.3, like the drawback, where you have claimed the customs duty drawback, are you eligible to claim refund of IGST? So there was an issue in initial period from 1st July to October 2017, 1st July 2017 to October 2017. Then it has been clarified through Circular 37/11/2018, stating that the drawback under customs has been recalculated considering only the impact of customs duty and not integrated tax. Hence, the duty drawback claimed by the assessee would not have an impact of integrated tax portion in it, and only the BCD portion will be claimed as a drawback. Hence, the proviso to second proviso of section 54.3 will not contradict with duty drawback and IGST refund. Since the proviso says when IGST has been claimed as a duty drawback, you cannot claim it as a refund. Where I am claiming drawback of only customs duty, such proviso will not restrict me. So hence, as on today, the exporter can claim both the duty drawback and refund of IGST. Both are complementary to each other. It does not contradict with each other. You can opt for claiming both. There is no restriction. The next issue, supply to SEZ, as I said, supply to SEZ is always a zero rated category supply, whether it is for authorized operation or not, it will be treated as zero rated supply. However, when it comes to refund of such for such transaction, when you are claiming refund of accumulated ITC or integrated tax, you have to always also satisfy the condition that it has to be for the authorized operation. This conclusion comes with the harmonized reading of Section 16 and CGST rules together. Section 16 of IGST Act and CGST Rule 89 of CGST rules together as a harmonized construction. The same has been clarified through Circular 48/2018, dated 14th June 2018. The next issue, then whether the refund of compensation is available where the outward supply is not liable for compensation. Yes, it has been clarified from the department that when it has been a zero rated supply, as Section 16(2) says, even when the outward supply is exempt supply, but when it is covered within the concept of zero rated supply, the refund will not be restricted and you can claim it as a refund. So even the compensation cess, when you are procuring coal and you are exporting other product which does not have a levy of compensation cess, the inward compensation cess received on procurement of coal can be claimed as a refund for the export made after manufacturing such coal, and you can claim it as a refund of compensation cess. However, the credit of compensation cess cannot be set off against the liability of CGST, SGST or IGST. There is the clarification provided by the government. Next we will come to the refund with relation to duty-free shops. There has always been confusion whether duty-free shops are eligible for refund of that indigenous purchase of goods or not. In case of Sandeep Patil versus Union of India, and the decision made by Bombay High Court, and Atin Krishna, decision made by Allahabad High Court, stated that the supply made by duty-free shops are treated as export of goods, hence they are eligible for refund. Then one may also refer that the ROD Retail Limited, where the Delhi AAR Advanced Ruling has stated that duty-free, regarding to Flamingo Retail, they have to pay tax and they cannot claim the benefit of zero rate supply. They have to treat it as an intrastate supply and pay CGST, SGST. The department itself came up with a clarification after such AAR stating that such ROD Retail Limited pertains to duty paid shop and not duty free shops. Moreover, advanced ruling are liable only to the applicant and it will not apply to other industry people who are not related to such advanced ruling. So you don't require to follow or think upon the rational prescribed under ROD Retail Limited. You can go through this Sandeep Patil case law where they have detailedly discussed why duty-free shops can claim refund of input tax credit and how their supply can be covered within the perspective of export of goods. I'm not covering in detail of such transaction because of paucity of time. Next, can the back office support provided by the company in India to its customer company outside India can be set to intermediary services? So in this regard, there was a circular 107 where it says where the supply has been provided in principal to principal basis. For the purpose of claiming as an intermediary, you have to be an agent for the other person or you have to provide facilitation or working on behalf of other person. But when you are providing services on principal to principal basis, it cannot be treated as an intermediary services and it can be treated as a normal supply and get the benefit of export of services. However, unfortunately, through circular 127, the initial circular was withdrawn. Even though it has been withdrawn, the rationale provided under 107 is still sounds valid and you can take such stand. When you are providing on principal to principal basis, you can still treat it as an export of service and claim refund. You don't require to treat it as an intermediary services. With this, I have covered the issues related to zero rated supply. Now we can come to issues in relation to inverted duty structure. The inverted duty structure states that where the ITC has been accumulated on rate of inputs. Why they have covered the
Hello. Yeah. Can you little bit be near to the mic from this refund for inverted duty structure, please?
Okay.
Sorry.
Is it audible now?
Or clear? It is breaking. Yeah.
Okay. The inverted duty structure. So inverted duty structure section 54(3) states that when there is an accumulation due to rate of tax on inputs being higher than the rate of tax of outward supplies. Why they have not included input service and capital goods? They have covered only the inputs. Here one may question whether it is violating Article 14, that discrimination without any reasonable. See, as I said, refund is not an instituted right to a taxpayer. It is a specific provision provided in the law. They have, if the government, if they come up with the reason for the reasonable classification, why they have considered only input, not input service and capital goods, one may not challenge such refund provision based on Article 14 of Constitution, because Article 14 says only when there is an irrational, arbitrary, and unreasonable classification or discrimination, it is treated as violation. When there is a reasonable, it allows the reasonable classification. Here, if the government comes up with a reasonable classification, reasonable reason for classification, you may not able to be challenge such discrimination of input service and capital goods for the purpose of section 54(3). However, you may challenge the exclusion of input services and capital goods from the input tax credit portion, because it says you can claim the refund of ITC accumulated. It says accumulated ITC. There it does not say accumulated ITC of inputs. It says when that ITC has been accumulated on account of inputs, once the input rate is higher and it creates the accumulation, I can claim the refund of entire accumulated ITC. The section does not provide restriction only to inputs on such accumulated ITC. Hence, you may challenge the rule which restrict you from claiming the refund of inputs, services, and capital goods. The next thing, initial period from July 2017 to April 2018, the law allowed refund of input and input services also for the purpose of refund. However, through notification 21/2018, they retrospectively amended that input services cannot be provided for refund. Only inputs can be provided as a refund. As we said, the rule itself we are challenging on its ultra-varying effect. Even this retrospective amendment can be challenged based on Keshavan Madhavan Menon versus State of Bombay, where it says unreasonable restriction upon statutory rights which affects the substantial right of the assessee with retrospective effect cannot be implemented from the retrospective date. We can challenge the validity of such retrospective amendment, and also taking into account of doctrine of fairness, we can challenge notification 28/2018, which retrospectively affected the right of the assessee of claiming such refund of on input services. So this is the second level of legal challenging such provisions. Initially, we are challenging there is no power to the rule to discriminate input services and capital goods in relation to accumulated input tax credit, because section 54(3) clearly states that when there is an accumulation of input tax credit on account of inputs, once there is an higher rate of tax for inputs, you are eligible to claim refund of your accumulated input tax credit. Your entire accumulated input tax credit, you are eligible to claim refund. So hence, such a classification can be legally challenged. And specifically related to textiles and textile goods, initially they were barred from applying refund under inverted duty structure. However, through notification 20/2018, with effect from 1st August 2018, they were allowed to claim refund of inverted duty structure with the condition that whatever ITC accumulated till 31/7/2018 will become lapsed. So this was challenged in Gujarat High Court in the case of Shabnam Petrofuels Private Limited, where the court said that once the ITC has been availed as per the procedure prescribed under law, it becomes an indivisible right, just like whatever principles we were following under STL regime, under the decisions of Eicher Motors and Aichi Kakaria, the same as rationale has been even prescribed under GST regime in case of Shabnam Petrofuels. So once you avail the credit, it will not lapse unless specifically provided under the law, under section 17(4) and 18(4), where it 17(4) and 18(4), where it specifically provides the lapse of credit availed. Apart from such scenarios, it cannot be lapsed. It is an indivisible right of the taxpayer. And Circular 135, next issue is Circular 135 says that when there is a subsequent rate reduction, you cannot claim the benefit of inverted duty structure. However, the law does not provide such interpretation. It is just a clarification from the government through it's an instruction to the officer. Such clarification doesn't seem hold good, because the section 54(3) clearly states when the rate of tax on inputs are higher to the rate of tax of your output supplies. It does not speak in the same period. It should not be of different period. It does not provide such conditions. So hence the clarification provided through circular deems to be invalid, and you can challenge that. Even when there is subsequent rate reduction, you can still claim the benefit of inverted duty structure. then there is a change in relevant date for the purpose of claiming refund under inverted duty structure through CGST Amendment Act with effect from 1st February 2019. Whether such amendment is period wise or refund application wise. So I am of the view that such amendment in relevant date applies only from the period February 2019 and it will not affect the prior periods prior to relevant date because it affects the right of the assessee to claim refund till the time limit as on that date at the time of providing such services. So till January 2019, the initial relevant date will apply. Then amended relevant date, the initial relevant date was end of financial year, and the amended relevant date is due date of filing 3B. The due date of filing 3B relevant date will be treated only from the period February 2019 and not prior to February 2019. With this, I have covered the issues in inverted duty structure. Now I will briefly go into the refund of deemed exports, where they have said where a person is supplying to EOU or a person having advance authorization and capital goods supply to a person having EPCG or supply of gold by a bank against advance authorization would be treated as deemed exports. The deemed exports provides from section 147 of CGST Act, where the law provides specific powers to the government to prescribe certain transactions as a deemed export. The deemed exports does not provide exemption from payment of tax. It says that the supplier has to still pay the tax and he has option of claiming refund of such tax paid, provided he has not collected tax on the recipient. So here it is normally based on the dominant position of either supplier or recipient in such cases. So the refund under deemed exports will be decided case to case basis who is dominant in dominant position in such transaction. If the supplier is dominant, what he would do, he would charge it as a normal transaction and he would ask the recipient to go for refund under zero rated supply, where when he provides exports after procurement of such goods. Where the recipient is dominant, to avoid cash outflow, he would say, I would not pay tax to you since you can claim the benefit of deemed exports. You pay tax from your own hand and get it as a refund. So when the supplier is opting for refund under deemed exports, abundant caution has to be given for documentation because specific documentation proceedings has been prescribed for deemed exports. So circular 14/2017 read with notifications 49/2017 prescribes the documentation requirements for the purpose of claiming deemed exports refund by the supplier. So unless you strictly adhere to such documentation, the supplier may not get the refund of deemed exports. So it is clear that for deemed exports, the supplier has to pay tax mandatorily. It is not like zero rated supply, like under LUT for without payment of tax and option of with payment of tax. Under deemed exports, the supplier is not left with the option of supplying goods without payment of tax. He has to make the payment. Either he can collect it from the recipient and treat it as a normal transaction, or he may pay from his own hands and treat it as a deemed exports and claim refund from the government, subject to the documentation adherence. Apart from zero rated supply, inverted duty structure and deemed exports refund, the other refunds which are covered under section 54 is where you have made the payment of tax, however the invoice has not been issued and the supply has been cancelled in subsequently, you can claim it as a refund. One may get surprised which all the transaction can be covered under this scenario. For example, where you have received advance. So once you are receiving advance, you are not required to issue invoice. You can receive receipt voucher, and the time of supply triggers for the purpose of services, and you have to pay tax for such services. And subsequently, the client, the supply has been cancelled. In such cases, since you have not issued invoice, you can either opt for claiming refund of such tax paid or issue refund voucher to the recipient and adjust against your liability in your monthly return. Both of the options you can opt. And next scenario which can cover under this refund option is when you have issued voucher which are identifiable at the time of issuance. So you would have paid tax at the time of issuance of voucher. However, you would have not issued invoice because the supply of goods has not been happened. And there is a time limit for such voucher, and the recipient has not redeemed the voucher within the time limit, then there is no supply of goods in such cases. In such case also, you may opt for refund of tax paid, provided you have to prove the unjust enrichment. You have to refund the tax to taxpayer, and then you can opt for refund of such tax paid at the time of issuance of voucher where you have not issued any invoices. And the next thing is, as we have already discussed, the general refund right, where there is no authority of levying law from the government, and even if they collect the tax, the recipient has the power right to claim refund from the government. That is a general power or rights provided in all taxation law, and it is accrued right to the taxpayer. When the law collected levied tax is unauthorized, you can claim it under refund. And there's a celebrated judgment of Mafatlal Industries in relation to refund, where they have bifurcated and classified unconstitutional levy and illegal levy. Difference between unconstitutional levy. What is unconstitutional levy and illegal levy? Unconstitutional levy means where the refund claim arises when the levy has been made outside the provisions of the Act, where the Act itself not provide the power to levy tax. However, you have made the payment, they have collected tax, your now refund claim arises. Such case is called unconstitutional levy. One example under GST might be ocean freight. What is illegal levy? Illegal levy is the tax has been paid by the taxpayer by misconstruction or wrong interpretation, or the tax has been demanded by the revenue because of wrong interpretation of the provisions of the Act, or by erroneous determination of relevant facts. In such case, it will be treated as illegal levy. Example, when there was an exemption notification, the department erroneously demanded tax from you and you have paid. So in such case, it may be treated as illegal levy and you can claim it as a refund. For detailed discussion on such unconstitutional levy, illegal levy, and the concept of refund, the genesis of refund, one may always go through the case law of Mafatlal Industries, which give a elaborated discussion and good clarity on the provisions of refund under indirect tax laws. Next, Section 55 of CGST Act provides specific class of persons who will be notified by the government for claiming refund. Under Section 55, as on today, 3 class of persons have been notified. One is a canteen stores department under Ministry of Defense, the military canteen. They can claim refund of 50% of central tax paid by them on their all inward supply of goods, not on services, only on goods. Whatever central tax they have paid, 50% of that portion they can claim it as a refund. And while notification 16/2017, specialized agencies of foreign consulates has been notified, like UN organization and foreign diplomatic consulates in India, embassies are notified as a specific class of persons who can claim refund of tax paid on their inward supply of goods or services. And recently in 2019, they have notified duty-free shops who supplies goods to outgoing international tourists. So they can claim the refund of input tax credit on such goods where the goods has been procured indigenously and they are supplying to outgoing international tourists. They can claim refund under Section 55 only on ITC on such goods. Even though there is a specific provision provided for such DFS only for supply of outgoing international tourists, it does not debar the rationale which is provided in Sandeep Patil case in Bombay High Court and Atin Krishna case provided in Allahabad High Court, where they are saying the supply made by DFS is covered under the export of goods and you can claim it under even 54, where you can claim the refund of input services also. Here 55 provides only refund of goods, ITC on goods which has been supplied to outgoing international tourists, whereas under Section 54 you can claim even the refund on input tax credit on input services. And one more thing, when you are claiming refund under Section 55, you should also be sure that the outgoing international tourist means a person who is not a normal resident in India and who is not going to stay in India for more than 6 months. Only to such persons, if the supply has been made, the DFS has the right to claim refund under Section 55, read with Rule 95A of CGST rules. If not so, you can always go for Section 54 refund under zero rated supply of export of goods, and you can follow the rationale prescribed in Sandeep Patil and Atin Krishna case in GST regime, and in STL regime in 2012 there was a case of Hotel Ashoka through Indian Tourist Corporation Limited, where Supreme Court. All this Supreme Court has also decided that supply made by DFS is treated as export under a STL regime. So you can also take a rationale provided to the Supreme Court in STL regime also. Now we will come to interest on delayed refunds. So once you file refund application, within 60 days from the date of application, the refund has to be sanctioned and credited to your bank account. Then there is a delay in payment of refund. You can claim interest at the rate of 6% from the 61st day of refund application. The case law which you can rely upon also, even though the provision itself provides you the right, this is the additional strength for your ground. Saraf Natural Stone, the Gujarat High Court has reiterated that department is bound to give interest at the rate of 6%, where the refund has not been distributed within 60 days from the date of application. In another case, in 56 itself, it says that where the refund is arising out of an order by adjudicating authority or appellate authority or tribunal or court, in such cases, the refund if the refund is not paid within the 60 days from the date of application, the applicable interest rate would be 9%. It is not 6%, it is 9% when the refund arises from the order of adjudicating authority or appellate authority, tribunal or court. Section 30, notification 13/2017, central tax, not rate notification, central tax notification 13/2017 prescribes all this interest rate under section 54. So you may also claim not only the refund when there is a delay, you have the right to claim even the interest from the government or the delayed payment from their end. And also one more thing which I want to provide to the notice of the participants before I conclude my session and give it for AKBAR sir for this value addition. As per Rule 9, read with section 54(5) and Rule 90 sub-rule 2, the department officer has to issue an acknowledgement within 15 days from the date of submission of application. Why I am stressing on this point is, once the acknowledgement has been issued, within 7 days from that acknowledgement, 90% of your refund amount has to be provisionally distributed to you. So now many of the officers are taking the loopholes by not issuing acknowledgement to the refund application. They are trying to avoid distributing the provisional refund within 7 days. So if you are keen to claim the refund on provisional basis, ensure that the officer is issuing the acknowledgement for your refund application. If he is not issuing, kindly follow up with him and specify the Rule 92, which specifically mandates the officer to issue acknowledgement for your refund application within 15 days from the date of filing. Get that acknowledgement from him so that you can insist upon the provisional refund within 7 days. With this, I would like to conclude my deliberation on the resolved and unresolved issues along with the case law reference. Now I would request AKBAR sir to provide his expert value addition on my deliberation. Thank you. AKBAR sir, over to you.
Thank you, Arjun. It was a very good presentation. I would give my comments from the latest topic, that is the interest portion, what the last point what Arjun talked about, since that is fresh in everybody's mind. So I would like to talk about that. See, now whatever Arjun told, I'm adding further to that a practical issue, maybe a value addition. See, you get 9% interest as a consequence of an order of a tribunal or a court. An example could be, I'm contesting an issue and have paid an amount under protest, or department has forcibly asked me to pay the amount. So I've paid that amount and I'm contesting that issue. So the issue attains finality maybe at SUDHIR, High Court or Supreme Court level. So in order to attain finality, the issue may take its own time, say for example 8 years, 10 years. Okay, so once the matter has been decided in your favor, thereafter I file a refund application. So when I file a refund application, this 9% interest is given to me from the date I file the refund application. That means I have filed the refund application only after 10 years. That is when when the matter was decided in my favor. So the value addition point here, what I'm trying to give you now is, when you are sure that an issue is bound to be decided in your favor, okay, so in that case you make the payment 10 years before and immediately pursue that as refund also, so that after 10 years when you win the case, your interest will be given for 10 years, not for the limited period of 6 months or 1 year from you have filed the claim. I hope everybody is clear on this point, right? So by doing this, by pursuing the refund simultaneously after making the payment, you enlarge your scope of interest for the period for which the matter has been decided, for which the case has been continued. So this is one immediate point what came to my mind. So my next point would be on this Pitambar case decision of Delhi High Court, wherein Arjun was talking about department extending the time uniformity for the claims. See, the rationale behind this is, for limitation, you have a period of 2 years to file a refund claim. So when you have a 2 years time period to file a refund claim, why give a cutoff bit restricting to file a refund claim within 1 year? So when you have a limitation of period to file a refund claim within 2 years, so that 2 years period should be given sequentially. For example, let's take an example. I'm exporting the goods in the month of last week of March. I'm raising an invoice, but the goods are actually getting exported in the first week of April. So it is getting split into 2 financial years, so which creates unnecessary complication. And also, if you look into the definition of export of goods
Akbar
means
sir,
taking the goods out of. Do is, last week of the month I raise an export invoice, and by the time goods.
hello.
Yes.
Sir, can you repeat last 1 minute? The voice
Yes,
was
Karan.
breaking. Sir, the voice was breaking. Can you repeat once the last 1 minute?
Karan, you are telling something?
Hello.
Sorry.
Sir, can you repeat the last 1 minute?
Yeah, Karan.
Sir, I'm
Okay,
audible
good.
to you.
Yeah, Arjun.
Sir, you can continue from that exports which you have covered on that March and April. So from that you can continue.
Okay. Okay, fine. See, I have raised an export invoice in the month of March, last week of March, and the export completes in the first week of April. So if you look into the definition of export of goods, the definition of export of goods means taking the goods out of India. So in the month of March, I have raised an invoice, and in the first week of April, the goods move out of India. So when is the export completed? So it is in the month of April, not in the month of March when I've raised an invoice. So considering these difficulties, the decision of Delhi High Court was rendered. So that was my first point with respect to extending the uh, time between 2 financial years, as long as it is within the refund claim period. The second point what Arjun deliberated on, LUT, letter of undertaking, if there is a delay in execution of letter of undertaking. See, this issue persisted even during the erstwhile regime of excise. Even there were series of demands being made on assessee for the simple reason that LUT was not executed, but assessee exported the goods, and demands were made on the export values. So one decision, well-known Polyster's Delhi Sister decision, which has told that as long as there is a proof available that the goods have been exported, you have shipping bill, you have customs attest on that, merely for non-execution of LUT, the demand cannot be made on that. So it is merely a procedural lapse. So we can definitely go back to the erstwhile regime to take case laws with this aspect. Next point, with respect to Rule 89(4)(c), which talked about 1.5 times on the value of export. I have my understanding of this Rule 89(4)(c) is this 1.5 times restriction is given only for the purpose of claiming refund in the formula. It has nothing to do on your invoice value. My invoice value is 1 lakh rupees, and if my domestic value is 30,000 rupees for the same goods, for the purpose of claiming refund under 89(4)(c), they say that your export value should be restricted to 45,000. That is, 30,000 is my domestic value, and for the purpose of claiming refund it should be 45,000. That is in the formula itself. Your invoice can continue to remain at 1 lakh. So what 89(4)(c) is doing is they are only restraining your refund to 45,000 being the export value, but your invoice value continues to remain as 1 lakh, which is a transaction between you and the customer outside India. So that has not been questioned. 89(4)(c) is only restricting your formula to determine what is the export value, which is purely arbitrary, and definitely this cannot sustain. It would definitely be challenged and it would be overruled. This may be what do you call, it can be held as invalid and going beyond the provisions of the law. So the point here what I wanted to emphasize is your export value section 15(5) what Arjun was referring, that has nothing to do with 89(4)(c) is my view. It is only the export turnover formula is getting restricted with this formula is the point what I wanted to drive home. Next point, Arjun was referring to Rule 9610. Yes, I am just adding on to the point what Arjun wanted to tell there. See, Rule 9610 says that in case an exporter has received any goods from a merchant exporter or under advance authorization, so the Rule 9610 does not specify until when I am restraining from going for export on payment of IGST. That is, until the stock of goods what I have procured, until when the goods are available with me, I cannot go for it, or for the entire year or for the entire lifetime. So this aspect is not clearly being brought out in Rule 9610. So what Arjun also wanted to bring out in this point, I believe, is until the goods are there in stock, until that point of time, the exporter is restrained from going for export on payment of IGST. Next point is Rule 96B. See, this Rule 96B is clearly going beyond the provisions of the law, as Arjun brought out intercontinental decision. See, the point what I wanted to emphasize here is, if I go to the act, it only says export of goods means goods moving out of India. There is no condition that I should bring the foreign exchange for goods, unlike for services. So when that be the point, only for the purpose of refund, how can you raise the bar by bringing in a mandatory condition that I am supposed to receive the money in foreign exchange also within the permitted time. See, now like Arjun talked about intercontinental decision, which talked about rule cannot go beyond the act. But the problem in India what we have is, whenever we have a Supreme Court decision, we have a subsequent amendment made by the law. Even in case of intercontinental decision, which was on reimbursement of expenses under service tax law, which talked about that reimbursement of expenses could not have been included for the purpose of valuation of service tax. So since the act does not specifically bring about this aspect, so the rule was uh, held going beyond the act. So subsequently, what did the lawmakers do? They brought this reimbursement aspect in the act itself, so that they could overcome the decision of Supreme Court. So my feeling is, though now Rule 96B is going beyond the act, maybe like previous acts, we can definitely expect that this thing would come in the act only once we have a high court ruling on this particular aspect. One more point what I want to drive home here is Rule 9610 talks about interest, and it also talks about penalty. So the point on interest, if I go to section 50, interest is for delaying payment of tax. So here is a case where I am claiming a refund for having exported the goods. So merely for not having received the money within the timelines, how can you impose interest on me? Point number one. So this also should be read with section 50 is the point what I wish to drive home. So there is a mismatch between the interest provision under section 50 vis-a-vis rule 96B. Next point what I want to drive home is imposition of penalty if I don't pay back the refund along with interest if I don't receive the money within the timelines given by FEMA. So the imposition of penalty under 73 and 74, there are no elements of 73 and 74 penalty in the export transactions. When I'm doing an export, the transactions are clearly brought out to the notice of the department. Customs department is acknowledging it. I am raising an export invoice. I am bringing out to the notice of the department. See, it is contingent when I will receive the payment or not. It is depending upon future events which I cannot envisage today. So for that reason, if I don't receive the payment after the timelines prescribed within the timelines prescribed by FEMA, I cannot be imposed penalties. So the elements of section 74 penalties are completely missing under refunds. So therefore penalties could not be imposed is one point. Next aspect, Arjun talked about section 16(2)(c), which talked about rule 2A. If the in GSTR 2A, if the credits are not reflected in 2A, my refunds are being denied. See, there's a established principles laid down by Supreme Court in case of KK Industries, which is again, this decision was rendered under erstwhile's central excise regime, wherein it was held that if the supplier has not paid the tax to the government, then the recipient cannot be denied the credit. So this principle can even now be applied even in GST or in this GST regime to challenge this 2A provisions. Next aspect, Arjun brought out on back office support service. So this back office support service, many assesses, the moment department finds there are three parties to a contract, department sees that I am an intermediary and denying the benefit of export. So the aspect what the department is missing out is they are not looking into the privity of contract. An example, the I have a contract with my foreign parent company who is outside India, and I am supposed to do back office support. So the contract, I have a contract with my foreign parent company, and and I am supposed to do the work for an Indian entity in India. So I don't have a privity of contract with the Indian company. I have a privity of contract only with the foreign company. So I am only liable to answer to my foreign company. So, and when I don't have a privity of contract with the Indian customer of my foreign company, how can you say that this is a tripartite contract, and how can I be held to be an intermediary? So this privity of contract aspect is missed out by the department. So this is one point what I wanted to drive home here. Next, deemed exports. On deemed exports EOU compliance, the practical difficulties what is faced by a supplier who is supplying goods to an EOU. When a supplier of goods supplying goods to an EOU files a refund, the department is questioning and calling for the documents of the EOU unit what they are supposed to comply in terms of Circular 14. EOU unit is required to give maintain that Form B. They have to intimate the jurisdiction of the assessee, and they have to intimate the jurisdiction of the EOU unit. So if the supplier to EOU is filing a refund, then the department is asking the documents which were supplied by the EOU unit to its jurisdiction, whether those documents have been submitted by the EOU's jurisdiction department to the assessee's jurisdiction department, which assessee absolutely have no control over it. So such documents have been asked for claiming refund by the supplier of EOU. Next, Arjun also talked about the dominant party claiming refund, because here in deemed export, either the supplier to EOU can claim refund, or the EOU unit as an export they can claim refund. So here the dominant party in majority of the claims being the EOU units, so they are playing the cards and saying that the supplier can claim refund. So the EOU unit does not want to block its credits. So unfortunately for the supplier of EOU, they have lot of additional compliances work to be done. Instead, if the EOU unit claims a refund, it will be a direct export, and they can get 90% provisional refund also if they go for exports. So this advantage is there for an export oriented unit rather than a supplier to an EOU. Next aspect is with respect to this unjust enrichment. See, of late department always sees what is this unjust enrichment. Unjust enrichment is if I have wrongly paid tax, wrongly collected tax from my customer, and I cannot again claim refund from the department. Hello.
Yes, sir,
Okay,
you
fine.
can continue.
Okay. See, this concept of unjust enrichment. Now, of late, department always observes that if in case if the amount is debited to my P&L account, it is told that I have been unjustly enriched by increasing my cost to my customers by debiting it to my P&L account. For my subsequent transaction, I have got the cost, and therefore for my subsequent transactions, I have collected the cost from my customer. So therefore, for the previous transaction, you have been unjustly enriched. So this is the ground taken by the department to deny refunds in cases of unjust enrichment. So consistently, see, look into the cases where assessee is engaged in customized products. So in customization of customized products, there cannot be a uniformity of cost across products. So different products have different rates. So merely I having debited to my P&L account does not justify that I have been unjustly enriched. Some projects or some products I would have sold at profit. Some products I would have sold at a loss. Point number one. Point number two, when a chartered accountant has given a certificate after examining the books of accounts that the cost has not been passed on to its customers, so that certificate should be taken as a base unless department can prove contrary to the chartered accountant certificate. Now in most of the cases, in spite of chartered accountant certificates being given to the department ignores that, saying that amount has been debited to P&L account, so therefore department chartered accountant certificate is not being considered. So without bringing a contrary to the chartered accountant certificate, without telling how the chartered accountant certificate is wrong, department cannot say that the chartered accountant certificate is wrong, and merely debiting it to P&L account cannot be a straightforward case to hold that assessee was unjustly enriched. Whatever aspect I've talked about, there are decisions on this aspect also. Next aspect, the last point here is intention of not allowing capital goods credit. The intent refund of capital goods credit not being allowed. So the intention is the capital goods remain within the premises of the assessee, whereas using the capital goods, the inputs or the final products are getting exported. So therefore, on capital goods, refund is not being given to the assessee. I would like to recall a decision under Central Excise Regime, Converges India, wherein the Delhi Tribunal has held that there cannot be two different yardsticks for claiming credit and for claiming refund. What are the yardsticks for claiming credit? The same yardsticks should be applied for claiming refund. Now under GST, if you see, for claiming a credit, it says that input tax credit, whereas for refunds, it says inputs, input service, capital goods. So different yardsticks have been brought out. So these different yardsticks cannot be used for giving refunds and for giving credits. So these are my observations with respect to the today's topic. Over to Karan.
Thank you so much, sir. Shall we take few questions, sir?
Yeah.
Yeah. The first question is, how frequently refund can be filed?
See, there is no frequency provided. It provides a time limit. So in
Yeah.
there is
Yeah. Sir.
in refund provisions there is no specific frequency provided under the law. It says only the maximum time limit. It says within 2 years from the relevant date you can file the refund, and you can decide whatever frequency is comfortable for you within such time limit.
Okay. To continue this question, where can a person can a person now file the return for March 2019, taking the whole financial year refund claim?
Yeah, see, here you can claim the.
Arjun, you are not properly audible.
Am I audible now?
Yeah.
See here you need to file the refund application from the period April 2019 to March 2019. So here he can opt either. First we need to see whether he is opting for accumulated ITC refund or integrated tax paid refund. See, if accumulated ITC refund, presently we have to file periodically. That means for April 2018 to March 2019, you have to file a single refund application, selecting the entire 12 months period in the application. Then you can get the refund of the entire credit. If you are selecting only the period March 2019, then the credit pertaining only to that period would be allowed as a refund. And if you have failed to file refund application for previous period, or you have filed as a nil refund application erroneously, the department has clarified that you can file under RFD 01A under any other option, and describing the clerical error which has been happened to you. You can file a refund for such previous period, and in March 2019 you can file a specific refund application and claim the refund. Akbar sir, anything to be added?
No, Arjun. The only point is, see now, Karan, for the question is, now just because the period has been elaborated as allowed between 2 financial years, your refund application with respect to input tax credit gets linked even to your returns. So how you have disclosed the credits in your returns, so that also matters. So that aspect has to be kept in mind before filing a claim.
The next question is, even though the law says supply made to SEZ should be zero rated against LUT, if the supplier unable to execute LUT and charged IGST, IGST, is SEZ available for claiming refund?
See, as I have elaborated, zero rated supply is a category of supply and the rate of tax does not differ. The option for with payment of tax and without payment of tax is only for the purpose of refund option given to the supplier. So if the supplier opts not to file refund and he wants to charge GST to the SEZ, you need to charge only IGST, not CGST, SGST, because as per section 7 of IGST Act, supply to or by SEZ or developer of SEZ is treated as interstate supply. He can charge IGST and there is no restriction for SEZ to claim refund on their inward supplies which they are using for their own exports. So they can claim refund on their inward ITC. Even the form has been prescribed last year in 2019 October. I don't remember the exact notification number. They have notified the refund application even for the SEZ unit to claim their accumulated ITC.
The next question is, what would be the time gap for filing refund? Example, supplier has raised invoice in January, recipient accounted in March, and recipient will file refund in March. But this transaction will not be reflected in 2A in March. How department will be handling this, Arjun?
See here, I think he is confused with the queries. I'm thinking it is in the context of matching of 2A versus 3B. So here, for the purpose of claiming ITC, as I said, the department is presently verifying the 2A, which has been reflected, which are getting reflected. So here the query is whether the supplier has filed his returns in the month of April. So here, even though he is filing delayed in the month of April, if he is filing such invoices for the period of return of March, such invoice will be reflected in 2A of March itself. Or if it is reflecting in April month, you need to decide to combine both the March month and April month refund application so that you can claim the refund of all ITC. Presently, we are telling challenge the legal validity on such 2A verification because that circular 135 says only whatever reflecting in 2A is eligible for refund. It is ultra varying the provisions of the law. So you can challenge that. Or if you want to claim in a smoother manner, if you want to avoid litigation and claim the refund, you can combine the refund application for both period March and April, and then you can file the refund application so that all the invoices will be reflected in GST.
The next question is with respect to Rule 89(4)(c). Okay. Can a stand be taken that the condition of 150% is per unit wise, not on the total amount of turnover?
See, as per my interpretation, by reading that rule, it provides unit wise. We cannot take it as a total turnover wise, because what happens if I have only 20% turnover on domestic and balance 80% is on export? I cannot compare 20% and 80%. So what valuation that 150% is being provided in the rule has to be on unit wise rate, not on the total turnover. This is maybe. Akbar sir?
Akbar sir?
My view is now it is, since it is 20% is there now in your example, it is 20% domestic and 80% exports. So as long as the goods are comparable with vis-a-vis domestic, so my understanding of this rule is it confines it to 1.5 times of your domestic. So if there is identical goods what you have supplied domestically, so I take that value. Say for example, that value is 30,000 domestically. So my export value should be restricted to 45,000. Whereas in my invoice it is 1 lakh rupees. So for the purpose of refund formula, I'll have to restrict it to 45,000, even though my export value is 1 lakh rupees. So this is confined only for the purpose of formula is my understanding.
Moving to the next question, Mr. X is wholly engaged in the export of goods and there is no domestic sale. in the month of December, he have reported the amount strong in GST at Rebi. He have reported in
Ajay,
taxable supplies
Ajay,
instead of zero rates.
Ajay,
Hello.
this query I would take it offline because it is a collector query. I would reply through mail that how to clarify with the customs department. I would give a mail reply. Uh, by being the paucity of time, we would select 2-3 queries which are important to address here, and I would answer currently. So here the next query is the section 16(3)(b) says that it is subject to section 54. Then it fairly gets covered within the rule 9610. Then what is the ambiguity on legal validity? So what I want to address here is section 16(3) specifies that a registered person making zero rated supply shall be eligible to claim refund. Then they are giving two options. After the options, it says in accordance with the provisions of section 54. So I can claim refund in accordance with section 54. However, for the purpose of option A and B, whether I need to go for with LUT or with payment of tax, option A provides subject to such conditions, safeguard and procedure as may be prescribed, and option B provides subject to conditions, safeguard and procedure as may be prescribed. Since as prescribed has been provided under IGST Act, it has to be prescribed. Normally, it has to be prescribed under IGST rules, through which powers they have prescribed such conditions under CGST rules. It was the question raised by me, and whether can they extend the word manner, which has been used in section 54, to such an extension that it even includes the restriction and conditions. This was the contention raised by me. This was I was trying to clarify. Akbar sir, anything to add upon this one, sir?
Can take up the next question. Nothing to add from us.
Okay. Okay.
What will be the treatment of supplies made from one EOU to another EOU?
For in case of supply of goods, they can either treat it, they can decide whether they want to treat it for a deemed exports or a normal transaction. But when it comes to services, it is a normal transaction for the purpose of GST. It is treated as at par with any other normal transaction.
We will be taking up the last question for
Okay.
96B, where you mentioned that even interest can be claimed back once the foreign currency as consideration is received. What is the legal backup for the same, Arjun?
So the legal backup is the wording is used in the 96B. It is refund of the amount paid. So once the amount paid, that means whatever tax plus interest they have collected. First, we are legally challenging the levy of interest itself, and we are challenging the rule 96B. The contention what I told was, if you assume everything is proper, legally perfect, that recovery is proper along with the interest, once you receive the consideration, the rule says that you can claim back the refund of the amount paid, amount recovered. So the amount includes even the interest portion which they have recovered, so that you can claim the interest also as a refund. This was the contention which I had.
Dear participants, the rest all the questions will be answered by mail. Thank you so much, Arjun and Akbar sir, for being part of the Hirgange Academy Advanced GST Certification course. Thank you so much.
Yeah, thanks, Karan, and I thank all participants for your patience listening. Thank you all.
Thank you, everybody. Thank you, Karan.
Yeah. We will be resuming the session by 11:50. Thank you.
Hi, Ashish.
This is the app we use that a lot of people who click on the Facebook or the Twitter or that dopamine usage that we need to learn
Ashish
something.
sir, can you unmute?
So you open this app and you can mention that
आशीष मेरा आवाज आ रहा? You are not audible, yeah.
Sudhir, you're visible. You're audible.
Okay, but Ashish is not audible to me.
Right. Ashish, sir.
Use the power of your voice. Now. Google keyboard. And rather than typing long messages, people composing is long. When you write a city, plus you can use a lot of these Alexa to do scheduling meetings, scheduling texts, reading your mails, reminding your flights. Really helpful. Start using text in your life. Email has a lot of keyboard and shortcuts. For example, if I have 50 mails to run through, if I use 20 minutes, mouse is such an inefficient way of doing work. Keyboard is the fastest way of doing work on a laptop. Google Apps, this slide or this was prepared on Google Apps. Multiple, earlier what we used to do was make a presentation, send the person to somebody, he used to make changes.
Ashish, you are speaking?
We used to do it earlier. This time what we did was, team members and I sat together and collaborated.
Okay, you are audible.
So this presentation, 5 people, 4 people working together to make this presentation. Similarly, office work, Google Sheets, Google Docs.
Sudhir, you just speak once.
I'm audible now. Am I audible?
Yes, sir. What I will do, I will just connect from the mobile. You may have to.
क्या हुआ?
Ashish, half an hour is gone. Do you still want to continue? Excellent app again to help you with this. And do this self-review. Believe you me when I say this, it will.
Ashish, I could not listen to you.
Once you going away, you can do self-review or you can show it to your mentor.
Yes, Sudhir, am I audible now?
Yeah, you're audible.
So what I may have to do, I may have to join from the mobile. There is some problem in the laptop. So can you run the PPT or current?
Yeah, Karan, either Karan or Arjun could be better.
Both of them are there.
Yeah.
Sudhir, whether the video is on or off? Sudhir, am I audible?
Sorry, you are audible. I was on mute. आपका video नहीं दिख रहा.
I think mobile में this video option. पता नहीं laptop क्या हो गया.
So this is Ajay here. Arjun will be taking up the PPT. I will be introducing you. So you are not audible, sir.
Am I audible now?
Yes, sir. Ashish, sir, you are audible.
Yeah, Ajay,
Okay,
that's good. My introduction again not required. I've been already introduced.
Okay.
You can just
Karan,
say that it's been already introduced.
PPT would be run by Arjun.
Yes, sir.
So Sudhir, can you send updated PPT to Arjun?
Right away. Arjun, you are around?
He will be joining in a minute, sir.
Okay. I've sent the PPT to both of you.
Sudhir?
Hello, Ashish.
So it would be starting 11:50 na 2 minutes.
हाँ, आपका वीडियो नहीं आ रहा आशीष.
Yeah, I'm doing it from the mobile and I'm not finding the option of video in the mobile.
Okay, then go without video. Arjun is back.
Yes, sir.
Yeah,
Is the
Arjun,
screen
right? Got the PPT?
visible, sir?
You got the PPT?
Yeah, I got the PPT. Is it visible now?
No, I'm not. I'm only able to see my screen. I don't know.
Okay,
Yeah, it is not visible as of now. Yeah,
Yeah.
now it is visible.
Shall we start, sir?
Yes.
Welcome back to all the participants for the second session of the day. We have the speaker CA.ASHISH sir with us to discuss on interest, penalty and recovery under GST, and Sudhir sir for his expert comments. The brief introduction about Ashish sir is, Ashish sir have qualified in November 2009, having academic background with All India 27th rank in CA final, 12th rank in CA PE2 and 22nd rank in CS final, leading advisor litigation and audit division of the firm for NCR region. He has exposure to international taxation and has actively contributed in implementation of VAT in Dubai and Saudi Arabia. He has been special invitee of Indirect Tax Committee of ICAI during 2016-19 and recognized faculty of ICAI for taking certification courses on IT for ICAI. Prolific speaker, having addressed more than 150 seminars on indirect taxes across various educational, trade and professional bodies. Have co-authored books on central excise, service tax and GST, and contributed to the background material and other publications of ICAI on GST and UAE VAT. He has advised multiple clients in various sectors on various aspects of indirect taxation, including construction, FMCG, entertainment, transportation, trading, etc. With this brief introduction, I welcome CA.ASHISH sir. Ashish sir, can you forward the session?
Yeah. Thank you, Karan. Am I audible?
Yes, sir, you're audible.
Yeah. Good morning, all the participants. First of all, I'll seek some apology for not able to be live on the video. There have been some technical issues, so I am available in the audio mode. Thanks, Karan, for introduction. So in this webinar series, where the attempt has been to discuss on the advanced aspect of GST, and in that series, today we are going to discuss on the some important aspect of interest, penalty and recovery provision under the GST law. So how we are going to plan this session is, first we will discuss on the interest aspect, wherein I will be discussing on some of the jurisprudence of the erstwhile indirect tax and under the GST also, and we will seek expert comments of Mr. Sudhir, and then followed by the other session or other aspect of the discussion. So Arjun, you can come to the next slide. Yeah. So if we look at the interest under GST or be it under any indirect tax law, first of all, it is important to understand what is the nature of interest. This is relevant because if the proper nature is understood, then whether it is going to be compulsorily levied in all cases or there had to be specific allegation by the department how the interest liability would arise, that has to be determined in the context in which the nature of interest has been held by the courts in the past. So the leading judgment under the erstwhile law on the interest has been of Pratibha Processor, where the Honorable Supreme Court has held that interest is compensatory in character and is imposed on assessee who has withheld payment of any tax as and when it is due and payable. This levy of interest is geared to the actual amount of tax withheld and to the extent of delay in paying the tax on the due date. Thus, essentially, it is compensatory and different from penalty, which is penal in character. So what the observation of the Supreme Court has been that when a person is not paying the taxes to the government, he is using the government money for the intervening period, and for using that money the government has to be compensated. So this is distinct from the penal nature. When we look at service tax law, where in between they had introduced different slabs of the interest, 18%, 24%, and up to 30%, based on the period of outstanding liability. But subsequently that amendment was withdrawn within a year, because when we look at the interest rate 24% or up to 30%, it start losing the characteristics of being in the compensatory nature and somewhat goes towards the penal in nature. So when we look at interest, because it is a civil liability and there is no need of establishing any mala fide intention on the part of the assessee for imposition of the interest liability. So in fact, there was an query, I would say a couple of days back, where a person in the case of real estate, he has applied before the commissioner for payment of that reversal of credit under the installment system, where the new 5% rate of tax has been adopted. So in that situation, the commissioner has not given opportunity of hearing as of now, despite repeated reminders. So the question comes, when there is no opportunity given by department, whether for the intervening period interest liability would arise. So answer to this question could certainly be found in these jurisprudence, where it says because it is civil liability, it is compulsory in nature, and whatever be the reason, so long as there is delay in payment of taxes, interest has to be there. And once the statute provide for interest, it is not open for the court also to I would say reduce or do away with the interest liability. And when we talk about this interest, again, there is no need of mens rea, means there is no need of guilty mind, there is no need of any willful attempt of tax payment, etc. So once it is held that tax was not paid within the due date, interest liability is automatic. But yes, one very important aspect is there cannot be interest on the interest liability. And this assumes a lot of significance under the GST also. Many times what happens, or what we have been seeing, is as a tax professional, we interpret the law, and we interpret the law in such a way that the conclusion, whatever we derive, we feel that this is the final conclusion. But many of the judgments what are coming in the GST law and in the past also, it is not always necessary that whatever interpretation is placed by us, the same interpretation is adopted by the court. So in that situation, wherever there is doubt, should we look at taking a position where, let us say, a tax liability one may take call to pay to the government because it is indirect tax, and if it is not collected and paid, there could always be a risk of business survival in future. But if something is to be paid out of own pocket, which could not be collected from the customer, or some input tax credit which has been taken where some dispute could arise, so in that situation we should always look at if interest liability could be postponed. Because reason being, if there are any possibility of interpretation where some favorable interpretation may come in the future, and where it may be held that there was no liability, so certainly there could be saving of the interest also. In worst case scenario, if it is held that there is liability in future, then once the tax is paid, so interest liability automatic freezes till that date. So this aspect we should keep in mind whenever we are advising to the clients, or doing any support function to the client. One certainly very important aspect emerges, and what is, I would say, in the question also is this, like for example, this brand equity judgment of Delhi High Court, where it has been held that Tran 1 can be open, or should remain open till 30th June 2020, and assessee should be entitled to transition the credit in GST. Thereafter, as we all know, government has introduced the time limit for taking the credit in the act itself, and that too retrospectively. So there could be many instances where the government may introduce retrospective amendment in the law, and that retrospective amendment could be to the negative or detriment to the assessee. Now the question arises whether on account of such retrospective amendment, whether there could be any interest liability on the assessee. So the answer we could find in this judgment of Honorable Supreme Court in case of Star India Private Limited, where Honorable Supreme Court has held that there cannot be interest liability if the law is amended retrospectively. So wherever there is any retrospective amendment in the law, certainly before deciding to pay the interest, one has to keep in mind this important judgment of the Honorable Supreme Court. We move to the next slide, where how this interest liability is provided under the GST law. So the section 50 of CGST Act deals with the interest liability, and as we all know, there has been the biggest problem since GST implementation is whether the interest liability has to be paid on the gross liability or the net liability. Primarily in those cases where there have been delay in filing GSTR 3B, and though there was sufficient credit available in the electronic credit ledger. So a question arises in that situation whether the interest has to be paid on the net amount or on the gross amount. The story has been very big in mega engineering judgment. Telangana High Court has held that interest liability has to be paid on the gross amount. There were numerous rounds of discussion in the GST Council meeting, and finally in the latest meeting in March 2020, the Council took a decision to that amendment effect to be given retrospectively, so that from July 17 till date, whatever interest liability or wherever there were delay in filing of GSTR 3B, interest liability should arise only on the net, not on the gross. So when we say net, means whatever has been paid through cash. But we have to be very careful of couple of aspects. One is that the proviso what has been introduced in section 50 subsection 1, it specifically provides that the interest on the tax payable in respect of supplies made during a tax period and declared in the return for the said period furnished after the due date in accordance with provision of section 39, except where such return is furnished after commencement of any proceeding under section 73-74. So in that situation, tax interest shall be levied to the extent tax is paid by debiting electronic cash ledger. So for invoking or taking this benefit of interest liability on the net, this payment or the return filing should be before initiating the proceeding of show cause notice by department under section 73 or section 74. So after this council meeting, it has been provided that it will be a retrospective amendment, but the irony is that the Finance Act section 100, wherein this has been provided, it has not been notified yet. So the position what stands today is that though the council has recommended it to be retrospective application, but as of now it has not been enacted in the statute. And as we recollect that in case of Refex Industries Madras High Court recent judgment, where the Honorable High Court has taken a view that the amendment is retrospective, where the court have taken a view on the understanding that the amendment has already become effective. But it seems that the correct proposition was not laid before the Honorable High Court, and to that extent the judgment of Honorable High Court is somewhat not in sync with what is existing in the statute book. Somewhere the question before government is or could be that once they introduce it a retrospective amendment, then the question will come as to what about the interest liability of the registered person who have already paid interest in the past. As we all know that Article 265 of the Constitution of India provides that no tax or penalty, no tax can be levied without authority of the law. So once it is held to be that it is a retrospective provision where interest can be collected only on the net cash liability, tax paid through electronic cash ledger, the question would arise whether government can retain the interest what has been collected on the gross amount in the past. Certainly, as an assessee, I can file the refund claim under Section 54 of the CGST Act on the ground that the interest amount, whatever has been paid, is or was not required to be paid under the law. But the question could come if somebody had paid it prior to 2 years. In that situation, whether the time limit would be applicable or not. Certainly, there could be challenge in terms of the time limit because if we see in the erstwhile law also, where the section 11B was there, so where the, in case of Mafatlal Industries judgment and thereafter in various judgment, it has been held that all the refund claim has to be filed under section 11B, whether the tax collected is with authority or without authority of the law, or I would say whether it was provided in the law or not. Though there are some contrary High Court judgment also where it has been held that if the tax is collected without authority, government also cannot retain it and time limit is not applicable in such cases. So certainly, once the government introduced this retrospective amendment and wherever the time limit has not expired, one should immediately file the refund claim. Wherever time limit has expired, there also certainly refund claim should be filed, and if it is rejected by the department, then probably some may have to go to High Court under Article 226 of the Constitution of India. So this is one, I would say, important aspect in terms of interest on the gross liability vis-a-vis net liability. So let us move to the next slide with some more important aspect under the GST in terms of the interest liability. So Arjun, please move to the next slide. Yeah. The next question come is, there could be many times situation that where the one could be situation, let us say in case of month of April, the return was supposed to be filed by 20th of May, and instead of 20th May, it was filed by 25th May. So in that situation, that proviso would come into picture, and for 5 days, interest liability would arise only to the extent of tax paid through electronic cash ledger, presuming the law is made effective. But what if, let us say, some of the invoices of April months remained unpaid or not declared in the 3B of filed on 25th May, and let us say those invoices are disclosed in the 3B filed in June 20th. So in that situation, whether interest liability would arise on those invoices or not, and presuming that there is sufficient input tax credit available with the assessee during that period. So if one looks at the provision of section 50, it provides that proviso provides benefit only in such cases where there is delay in filing of the return. But if there is delay in reporting the invoices and delay in the payment of tax liability, that benefit, it seems, is not coming out of that proviso. But certainly, when we look at the nature of interest, which is in the compensatory in nature, and if I do have sufficient input tax credit available with me, and the delay on account of late reporting of the invoice has merely resulted, or I would say where sufficient credit is available, it could be said to be compensatory in nature, and a view may be taken that there is no interest liability. But certainly it is a matter which has to be contested because it is not getting squarely covered by section 50 of the CGST Act. So this certainly second aspect, interest on amount deposited in the cash ledger. So many times it happens that the amount is lying in the cash ledger, but it is not set off timely. So in that situation, what is the characteristics of the amount in the cash ledger? So Honorable Telangana High Court in case of Mega Engineering had held that it is like amount lying in the cloud, where it it is not available to the government also, so it cannot be said that tax liability has been paid. But we also need to keep in mind that whatever amount is in the cash ledger, it is not directly available to the assessee. It is somewhere available to the government only, and if one needs to take that money back, he has to file the refund claim. if we see in the erstwhile Central Excise Act, where the concept of duty payment through PLA used to exist, so there are the jurisprudence that once the tax amount has been paid or once the tax amount has been deposited in PLA account, there cannot be interest liability for delay in discharge of excise duty. How all these aspects are going to turn up, it has to be seen in the future, but certainly if the amount is in the cash ledger available, a view may be taken by the assessee. Then the next important question normally in case of interest arise as to whether there is any interest liability in case of supplementary invoice or debit note. So in that situation, when we see this provision in the erstwhile Central Excise Act, it has been a long drawn battle, and finally Supreme Court in case of Steel Authority of India in 2019 post GST, it was held by Honorable Supreme Court that the interest liability would arise in case of supplementary invoice. So where the goods were originally cleared by the assessee on a particular month and supplementary invoice is issued after, let us say, 6 months. So the liability being on the event of clearance of the goods from the factory, and by delaying or by reducing the value on the date of removal of the goods from the factory, the excise duty what was paid to the government on the very first day was paid lesser to that extent, and because it was paid less, so there has to be interest liability to the extent of the amount covered by supplementary invoice or the debit note. Now the question arises in GST, what is going to be the proposition of this judgment, or whether there will be interest liability under the GST on the any supplementary invoice or debit note issued by the supplier. So if one look at this proposition, the answer to this one can probably look in the section 12 subsection 2 of time of supply, when we look at in the context of the supply of goods, where the explanation 1 to the subsection 2 provides that supply shall be deemed to have been made to the extent it is covered by the invoice, or as the case may be, the payment. So once the invoice is issued on the date of supply and there is subsequent price increase on account of any post facto event, so in that situation the supply is deemed to have been made to the extent the invoice has been raised on the date of supply, and the time of supply for any increase in the value in the future date, the time of supply for that debit note should arise when that debit note or supplementary invoice is raised. So based on that, certainly a proposition what arise under the GST law is that there should not be any interest liability on the supplementary invoice or the debit note. Then certainly this period of limitation for interest liability, so we all know that under the GST, the maximum time limit available with the department to adjudicate any matter under section 74 is 5 years, and under section 73 it is 3 years. So the question arises whether the time limit would be applicable for interest also. So there in that context, it has been held by Punjab and Haryana High Court in the erstwhile law that this time limitation is applicable in case of interest also. So there cannot be any interest liability after the time limit expires, whatever is provided for the adjudication under the law. But if one look at the section 75 of CGST Act, so there is one exception to this particular proposition, where it says that in case of self-assessed tax liability, in that situation the time limit is not applicable for the interest. So in that situation the department can directly initiate the recovery proceeding, and interest liability can be recovered. So to that extent, one need to keep in mind that once the tax liability has been self-assessed by the assessee, in that situation there cannot be any I would say benefit of the interest or saving of the interest. Arjun, please move to the next slide. So then another question what arises under the GST in terms of interest is that in terms of gross interest liability, what we had discussed, where the department had initiated provisional recovery against the various assessee. So there it was held by Karnataka High Court in case of LC Infra Project Private Limited that unless the show cause notice is issued and the interest liability is adjudicated, there cannot be direct recovery of the interest amount from the assessee. So one has to distinguish between the self-assessed liability and interest thereon vis-a-vis liability which has not been self-assessed, which is sought to be levied by the department but which is contested by the assessee. So wherever it is contested by the assessee, in that situation without show cause notice, department cannot directly proceed for recovering the interest amount. This we are further going to discuss in the course of our discussion on the recovery part of today's discussion. Then section 75 subsection 9, it specifically provides that sometime what used to happen in the past, that department missed to mention the interest liability on the in the adjudication order. So there have been judgment where both sides the view have been taken. So here the law has specifically provided that if there is no mention of the interest on the order, but it has been held that tax liability exists, so interest liability will be automatic. So even that omission in the order will not give the benefit to the assessee from the payment of interest liability. Certainly this interest on self-assessed tax we have already discussed. This judgment of Star India for the retrospective amendment we have discussed. Now one more question in the interest liability arises, that in case of provisional assessment, where if a person is not able to determine classification or valuation at the time of original removal of goods under central excise, and that point of time the manufacturer adopt the provisional assessment, and subsequently that liability gets increased in the final assessment, and the assessee paid the tax liability voluntarily even before the final assessment by the department. So it has been held in case of CAT Limited that there will not be any interest liability, because the interest liability what the law provided that it shall arise at the time of finalization of provisional assessment. So if a person has already paid before the provisional assessment, there cannot be interest liability. But if one looks at the proposition under the GST law, here the law had specifically provided for interest liability. So this provisional assessment, even if a person pays before the finalization assessment, there would be interest liability under the GST law. Next slide, Arjun. Yeah, so this whatever we have discussed pertain to interest liability on the outward side. Now if we look at some of the aspect of interest liability on the input side, so in case of input tax credit, again if you look at section 50 is the only provision which deals with the interest provision. Subsection 1 provides for 18% interest, subsection 2 provides for the interest to be computed in the manner as may be prescribed. Subsection 3 provides for interest at the rate of 24%. Now the question arises whether the input tax credit, if wrongly taken, or let us say the amount is not appearing in the 2A. So in that situation, whether the interest liability would arise under subsection 1 at the rate of 18%, or would it arise under subsection 3 at the rate of 24%. So if one look at the subsection 3, it specifically covers only those cases where undue or excess input tax credit has been claimed under the provision of subsection 10 of section 42. And this subsection 10 of section 42 is based on the concept of GSTR2 and matching concept, where there was intimation to both the parties, and even after the intimation the credit is not reversed. So in that situation the law provided this mechanism. Now when the GSTR2 and GSTR3 itself is not available, and merely because an entry is not appearing in GSTR2 doesn't mean that tax liability has not been paid by the supplier. So it would be incorrect to take a view that the interest liability on the input tax credit availed which is not appearing in 2A would be 24%. In my view, that is not a correct proposition of law, and in case department alleges this proposition, it has to be strongly rebut that there is no interest liability at the rate of 24% on merely because credit is not appearing in the 2A, in the absence of the entire mechanism not working under the law. Then certainly important question arise many times that input tax credit has been availed, but it is reversed before utilization. So in that situation, whether interest liability arises. So here it has been again a long drawn battle in the pre-GST regime, where the Supreme Court judgment in case of Int Swift or the Karnataka High Court judgment in case of Bill Force, where the different views have been taken. The view taken in the Karnataka High Court has been that there cannot be any interest liability if the credit has been availed but reversed before utilization, because in that situation it is merely a book entry. At that point of time in the Senvet credit rule, the wording used to exist availed and utilized. Availed or utilized. So thereafter the law was amended and specifically provided that interest liability would arise if the credit is availed and utilized. Now the question arises under GST law. What is the proposition? So if one looks at the section 73, it provides that where input tax credit has been wrongly availed or utilized for any reason. So in that situation, the show cause notice shall be issued as to why the person should not pay the amount specified in the notice, along with interest payable thereon under section 50. So here the question arises in that situation whether the interest liability would arise, and if that interest liability would arise, then at what rate. So here there has been a judgment itself under the GST Act, where the Honorable Patna High Court in case of Commercial Steel Engineering Corporation has held that the provision underlying section 73 is self-eloquent, and it is only if such availment is for reducing a tax liability that it wastes jurisdiction in the assessing authority to recover such tax together with levy of interest. But until such time that statutory authority is able to demonstrate that any tax was recoverable from the petitioner, a reflection in the electronic credit ledger cannot be treated as an availment. So when we discussed that interest is merely compensatory in nature and merely wrong availment of credit, there is no loss of revenue to the government where specifically the supplier has already paid tax to the government, then on the self reversal there cannot be any interest liability on the assessee. So that view certainly that judgment in the erstwhile law of the Bill Force Karnataka High Court coupled with this judgment would certainly give a strong ground to claim that there should not be any interest liability if it is reversed before utilization. Again, a question could arise sometime what happens that the vendor has charged the tax in the nature of CGST, SGST, but input tax credit has been taken in the nature of IGST. There also it could be possible that the input tax credit has been utilized, or it may be possible that input tax credit is not utilized and it is noticed beforehand only. So when it happens to be on the output side, on the outward supply side, where section 77 provides that if the wrong nature of tax charge, the supplier has to pay correct tax, but there is no interest liability, but there is no pari materia provision where when one looks in the input tax credit, and this could certainly give an impression that interest liability arise when the wrong nature of credit is taken. But there could be other argument also, that the segregation of tax between various nature is merely for the purpose of government to levy the tax in the different nature. Once the tax is paid to the government exchequer, whether under the wrong aid or corrected by the supplier, and once the recipient has availed the credit by satisfying the condition of section 16, a view may be taken that there is not interest liability merely because wrong nature of credit is taken. But certainly this is going to be subject to litigation in the future, and only the court would be able to take a view as to how this should be interpreted. Yes, Arjun, next slide. So a couple of other aspects in terms of interest is when we look at the interest on the refund. So there the law provides that the refund, if the refund is not granted within 60 days from the date of application, in that situation the department is required to pay interest from the expiry of the 60 days. So here also one need to consider the nature of interest, where it is compensatory in the nature. So in that situation, relying on the Tata Chemical judgment of the erstwhile law, certainly a challenge can be made before the High Court on the ground that once the government is not paying the refund, so in that situation, why the time limit should be counted from the 60 days? Once the assessee has applied the refund and which is valid, so in that situation, certainly the imposition of time limit in the statute, is it permissible under the constitutional mandate? Those aspects certainly could be brought to the before the court. So again, if I look at the last aspect of the refund, interest on the refund, so this aspect we have already discussed in case of brand equity judgment, where retrospective amendment has been introduced, whether interest refund can be claimed for the interest paid in the past. So these are the various aspects on the interest where the open issues are there, and past jurisprudence could give some guidance to us as to how one should take a decision in terms of interest liability wherever it is alleged by the department. So at this stage, I would invite expert comments from Mr. Sudhir into the interest related provision under the GST law. Yes, Sudhir.
Sorry, I was on mute. Thank you, Ashish. I think you have done a wonderful job in summarizing major issues which is coming out as far as the interest is concerned. So I have few things to be added here, which is more of echoing the views of Ashish, and also some thought process to be given. One is he mentioned that there is what happens if there is a delay in adjudication. Say, for example, a show cause notice has been issued, and you have promptly submitted a reply to the show cause notice within whatever reasonable time of 15 days or 1 month you have been submitted. Then the matter is not at all taken up for adjudication till 2 years or 3 years or 5 years. Then one fine day they take for an adjudication, and they say that whatever you have paid was whatever the demand proposed was right, and you have to pay the entire amount along with the interest. Now interest will be, say, 5 years into 18, it will nearly come to 100% of interest. The question arises is that because of the delay of adjudication by the department, whether I can say that interest is not payable. Had you been adjudicated within 1 month when I gave a reply, then I would have paid interest only to the extent of 1 month. Can I take this ground, which clearly has made a mention of the Supreme Court decision also, saying that it is a civil liability, and even if the fault is that of the government, you will not be able to do anything out of it. But what could be done there is that can you challenge the adjudication itself, that the delay in adjudication itself can be challenged. So there are various decisions. One among the recent decision is the Sangvi reconditioning in case of Mumbai High Court, where Ashish, you may have to mute. Sorry, Akbar, you may have to mute. Yeah. So so delay in that adjudication itself, they told that it is against the public interest and it is against the principle of natural justice. So the such show cause, the order passed against such show cause notice because of advertent delay, that order itself has to be quashed. So once the order quashes, you are no question of paying the basic interest penalty, nothing. So that is something which I wanted to add upon for you to keep in mind any such thing is coming. So another important thing which comes up is that if you carefully observe, there is no concept of interest on interest. So many of the cases, this is what has been resorted, where you are not very sure whether you are liable to pay or not, it has to be going for adjudication, first appeal, second appeal. So one of the things that we thought of is that you can pay the base amount, that is the proposed tax amount. Don't pay the interest and penalty. Penalty will come to it later. Don't pay the interest. So what happens in this case is that, say for example, if you are supposed to pay 100 rupees today, and you fight an appeal till the tribunal and you end up paying the same 100 rupees after 10 years, so you that 100 rupees of an interest, you have to pay the same 100 rupees once you fail after 10 years also. So there is no interest on interest. So something wherever there is a ongoing pending litigation, you can consider not paying interest but only the basic amount, because the moment you pay the basic amount, your interest become absolute, your meter stops. So after that, you pay that whatever 100 rupees of interest, not today, after 10 years. Maybe you make that money out of the amount which is available to you, which you would have either way not paid. So that is one of the things which I wanted to bring it to you. Interest on net and gross was well covered by Ashish. Mega engineering decision, retrospective amendment, but not been given effect to. So yeah, that notification is not been given effect to, but whenever one day or the other they have to give an effect. When they give an effect, it will be a retrospective effect. So thereby, from the beginning, the tax payable, the interest payable will be only on the cash portion of your tax which you are supposed to have been paid, wherever there has been a delay. So there are various writ petition in Telangana High Court only after the mega engineering which has been admitted on various grounds which has been taken, which was not discussed in mega engineering, because department is highly relying on mega engineering. Although mega engineering decision has been given by Telangana High Court, Telangana High Court is still entertaining the writ and giving stay for many of the cases post mega engineering. So the mega engineering decision had a lot of challenges, not only technically, the other ways also practicality. So there was some challenges in terms of this mega engineering decision. So we cannot too much rely upon that, is what I wanted to bring to your notice. 24% interest for ITC. You have to basically understand the mechanism when it was proposed. When GSTR 2 and 3 was in existence, GSTR 2 allowed you to take ITC by passing by entering a line item of your vendor, which was supposed to be auto-populated in GSTR 1A of your vendor. And next month you'll again accept it, and it will come to his 1, it will come to your 2A, and your 2 gets matched. So that was a circular control which was been proposed by the law at the initially, while the time of implemented. For some reason this has been removed. So with this 24% interest was also keeping that in mind, that if I am a fraudulent assessee or a I can't say fraudulent, or a chance taking assessee, I could also do is to manage my cash flow for this month. I could just put some dummy entries, take off the credit, and file the returns, so that everybody gets the credit, my customer and all. I do that. Then after that, when the other person is not there, not traceable, or anything is happening, I will easily get away with 18% interest. So that may be cheaper also for that particular businessman, maybe, I don't know. So to curb that practices and not allow to people to take dummy credit, the 24% interest was there. But that doesn't mean that there is a genuine case which you are having where you have actually paid for it. Due to the vendor's fault, it is not coming in your 2A. That 24% and all cannot be claimed at all. So that entire 24%, as Ashish has clearly told, will not be claimable because of that being in the what you call, that entire provision is for your GSTR 2 and 3 mechanism, which is not there. That has been rightly put up. Then interest for availment and not utilized, that also has been very clearly put across. So where the decision of the Karnataka High Court in case of bill forge made it very clear that where is the loss for the government. So IndSwift and bill forge are two different contradicting decision. In IndSwift, where they told you have to pay the tax, there was a dummy and a bogus invoices on which the credit was taken. Bills force was a genuine case where they had accumulated the credit and they would have not taken. There was no fraudulent intention at all. So thereby the fundamental question came is that where is the revenue loss? When I have taken a credit, it is a book entry with me. I have not paid you any short paid tax because of that. Thereby it is nothing to do with what you call loss to the revenue, and thereby there should not be an interest. Another thing closely, if you look at section 50 proposes interest only in one case where there is a non-payment of tax or a delay in payment of tax. So again, the reference is an output. Only when an ineligible ITC has been taken, utilized, then thereby there will be a shortage of paying tax. So thereby, if you have taken a credit not utilized, you need not be bothered. There cannot be interest which is coming, because many of the cases we have also been advising, especially say the construction where we are not very sure the construction credit against the rental is available or not. We are still suggesting you take it, but don't use it because interest liability anyway has not been good there. And also intimate it to department. Ashish is going to cover what will happen when you intimate it to department about the penalty. I'm not jumping the gun as of now. Next very important thing which to be looked at is whether this interest is automatic or a show cause notice should be issued. Many of the cases wherever the GST or 3B has been filed delayedly, say 1 month or so and so. So whatever the amount of tax is there, either gross or net, irrespective of that, the notice, recovery notices has been given to the banker directly, saying that so and so person has not paid he has delayedly filed his returns, and interest is the liability is coming to 3 lakhs, and remit this 3 lakhs directly to me. Till then, freeze his account. So can this be done? So the department view is that the interest is an automatic provision. As Ashish also told in the initial slides, you don't have an option at all. It is an automatic. So thereby there is no question of me giving you a chance at all as a principle of natural justice. But if you look at the broader aspect, not only the section, the principle of natural justice has to be followed, even if it is obvious that whenever a money has been claimed by the department, which is not self-assessed by me. Say if I am self-assessing in my 3B that this is the interest payable, not paid, then there could be auto recovery because I have what is assessed. They need not ask me again. But what I have not assessed as an interest self, there has to be a show cause notice. This has also been appreciated with various high courts, and they have given a stay against this auto recovery of interest. So that also has to come with the show cause notice. That is what I wanted to cover. Interest on refund, very clearly covered by Ashish. Wherever there is a delay in the refund, you are eligible for the interest thereon. But please be aware that this is not automatic. You have to make another application, either online or a physical letter filing, and claim the interest. It is not automatic. Many of the cases, the officers will discourage you to claim the interest. They'll say, anyway, we are paying refund now, leave interest. Please remember that is your right. Whatever the quantum it would be, irrespective of the quantum, it is a right which you are eligible for, and you have to claim the interest. So it's the same question you have to ask back to the officer. Say, I had not paid tax. I assume a moment I had short paid tax. When you came to me, I paid tax. Will you have been given me an interest waiver? Answer is no. He would have asked you to mandate you to pay. And that is the same thing. When you are supposed to pay me within 60 days and you are not paid within 60 days, in excess of 60 days, you are mandated with me to pay the interest, and that is my right, and you have to pay. So that is also not automatic. You have to ask for it. So these are a few points to add upon what Ashish has told. So over to Ashish to continue with penalties. We will take the question last, all put together.
Yes. Yeah. Thank you, Sudhir. So Arjun, can we move to the next part of presentation? So having discussed on the interest aspect, now let us have discussion on the penalty provision under the GST law and what has been the jurisprudence in the past. So again, when a person looks at the nature of the penalty, so unlike the interest where it was compensatory in nature, the penalty is something where there is civil wrong done by the person, and that wrong done is an intentionally wrong act done by the assessee. So it has been again held in case of Pratibha processor that mala fide intention required for imposition of penalty. Whether under the GST law, when we look at mala fide intention, it is nothing but mens rea. So the question would arise whether under the GST law, whether the mens rea is required for all nature of penalty or whether it is required only for some of the nature of penalties. So that certainly we are going to discuss in the course of our discussion, but certainly earlier speaker Mr. Anil would have covered e-way bill related penalty provision as to what have been held by the court in various cases under the GST about imposition of penalty like penalty on the any wrong e-way bill. So when we look at this, one has to make distinction between mandatory penalty vis-a-vis discretionary penalty under the law. So when we talk about the mandatory penalty, in case of mandatory penalty, there is no discretionary power with the authority also to waive that penalty what is provided in the law. But certainly in case of discretionary penalty, the authority can take a view based on the circumstances and facts of a particular case whether penalty should be imposed or not. So how can one nor identify whether it is discretionary or the mandatory penalty? So many times when we look at under the law, it says the penalty may extend up to 25,000 rupees. In other cases, it provides that there shall be penalty equivalent to 100% of the tax amount not paid. Like for example, section 74, if we look at. So wherever the law provides that it shall be required to be paid, in that situation, it shall be mandatory penalty. Wherever it is in the nature of discretionary penalty, there the power rests with the authority. So it has been held by Bombay High Court in case of Hindustan Petroleum Corporation Limited, relying on Supreme Court judgment of Dharmendra Processor, that in case of mandatory penalty, there is no option available with the department of waiving the penalty. It has to be mandatorily imposed on the assessee. But if assessee is able to establish that there was no mala fide intention, there was nothing wrong done deliberately, and it was mere some technical breach. So there is a celebrated judgment of Honorable Supreme Court of in case of Hindustan Steel, where it has been provided that even if there is mandatory penalty provided under the law, that mandatory penalty cannot be imposed for any technical or venial breach of legal provisions. So when we look at under the GST law also, in many of the e-way bill cases, though the law does not, the law section 129 provides for payment of penalty depending on the owner is coming forward and not under various instances, but the courts have held that if there are minor defects on the document which are rectifiable and it is not intentional, penalty cannot be imposed. So in that situation, the judgment of Honorable Supreme Court of Hindustan Steel, that is still relevant under the GST law. So one has to keep in mind as to the nature of mandatory penalty vis-a-vis discretionary penalty. So if there is any mala fide act and the mandatory penalty is provided under the law, in that situation, yes, that penalty has to be paid. There is no discretionary power. At the same point of time, there cannot be two penalty for the same offense. So this is provided if you look at Article 20 of Constitution of India, that a person cannot be penalized twice for the same offense. And not only that, under the CGST Act also, section 75 subsection 13 specifically provides that where a penalty has been imposed under section 73 or 74, there cannot be imposition of penalty under any other law. So in the course of our discussion, we will see various provision of penalty broadly we will see. So when one looks at section 122 subsection 2, that subsection provides for imposition of 10% penalty in case of cases not covered by fraud, etc., and 100% penalty in case of fraud, etc. In both the cases, 10,000 or that limit, whichever is higher. Now, when the show cause notice is issued under 73-74, and penalty is imposed, penalty is alleged in that show cause notice, the question could arise whether the penalty what is imposed under 73-74 is it different from the penalty under section 122 subsection 2. So the answer to this question lies in your section 75 subsection 13 itself, where it provides that once a penalty has been imposed under section 73 or 74, there cannot be penalty imposed under any other provision of the law. So these aspects we have to keep in mind with respect to penalty. Yeah, Arjun, please move to the next slide. So there are various precedents in the past. So how one has to establish, or what ground one can take to defend that there is no penalty. So unlike interest, where we had discussed that it is automatic, once it is ascertained that tax liability has not been paid or has been paid delayed, then for the intervening period interest liability would arise. But under the penalty, it is not merely that non-payment of tax would invoke penalty. It has to be established that it was something more than merely non-payment. There were deliberate act on the part of assessee to not to pay the tax. So if the tax is not paid due to bona fide belief, in that situation penalty cannot be imposed as held by Supreme Court in case of EID Perry. Many times it happens that, let us say, there are some input tax credit which are doubtful. If we all recollect that Odisha High Court in case of Safari Retreat has held that input tax credit can be taken on the construction related services when it is given for the renting of immovable property, when it is used for renting of immovable property services. Now a question could arise, if a person is taking input tax credit, if he directly takes input tax credit and tomorrow let us say it is held by Supreme Court that input tax credit is not eligible. So in that situation, whether penalty could arise on that person for availing the credit. The answer to that question would be certainly that the credit is taken based on the High Court judgment available on the same subject, and I would say to further safeguard one's interest, one should intimate to the department as to the reason or basis based on which that credit is taken. Once it is intimated to the department, it certainly becomes in the nature of a mitigating factor for imposition of penalty, and there cannot be an allegation tomorrow that it has been fraudulent act on the part of assessee, and in those situations the tax liability or demand, if any, can be made under section 73 only, not under 74, and under section 73 the tax and the penalty is only up to 10%, and the 10% penalty, though it is provided as mandatory penalty, but what we discussed in case of Supreme Court judgment, certainly that could be challenged on the ground that if there are some technical breach. So the intimation, if credit is taken after intimation to the department, that is a very powerful tool for mitigation of the penalty and also for non-invocation of the larger period of 5 years under section 74. And why only for the credit? This could be for the classification, this could be for the exemption, or if there is doubt as to any activity whether falling in the supply or not. In those cases, certainly if a stand is taken not to pay the tax liability, it should be very well intimated so that tomorrow there is no allegation or question of it being done deliberately with an intention to defraud the revenue. Next, if there are certainly divergent views of the court, there cannot be any penalty, and I would say not only the court, under GST certainly, where we are seeing that there are advanced ruling authorities of the various states. And why of various states? Within the same state, for the same matter different views are taken. For example, director's remuneration. So in that situation, once there are different views taken by the courts or authorities on the identical issues, and if the assessee relies on any favorable ruling or view arising out of that, there cannot be any penalty liability on the assessee on the future, because the divergent views taken by the court or authority itself establishes that it is not a case where the liability is already the matter is free from interpretation. Once the interpretation aspect comes into the point, there cannot be or there should not be imposition of the penalty. Matter involve interpretation of exemption notification, no penalty. Bharat Usually, in case of tribunal, suppression to evoke penalty. So here this aspect one has to carefully look at, because anytime when we handle any show cause notice, invariably department issues the notice under section 74, or if you look at erstwhile service tax law proviso to section 73 subsection 1, where it is held that if the audit was not done by the department, this would have never come to the notice. So it is in the nature of suppression, and the penalty would arise 100%. There was no definition of suppression under the erstwhile law, but it has been held by the Honorable Supreme Court in various cases that merely non-disclosure cannot be said to be suppression, where anything which is required to be disclosed by the law, which assessee fails to disclose, only those activities can be said to be falling in the suppression. Here in GST law, the suppression has been specifically defined, where it has been mentioned in the explanation 2 to section 74 subsection 1 that mere non-declaration of the facts and information which a taxable person is required to disclose in the written statement, report, or any other document required to be furnished under the Act, or where he fails to furnish any information on being asked for by the proper officer in writing, only then it will fall in the suppression. So the point comes, whenever we have any disclosure requirement, whether it is under GSTR 3B, whether it is under GSTR 1 or the annual return, if we are disclosing each and everything, there cannot be allegation of suppression in future. And at the same point of time, we need to keep in mind that many times we feel that if it is disclosed to the department, there could be counter action. But the view what one need to consider is that it is always better to disclose the tax proposition taken, because tomorrow if the matter is agitated by the department and it is held that there was suppression, in that situation the consequences could be severe in terms of 100% penalty and demand of the 5 years. So even if anything is not required to be disclosed in any of these returns, one could evaluate, explore an option of disclosure to the department. In our firm, certainly we have been using this, like I would say, Brahmastra, where wherever there is any doubt, an intimation is made to the department, and hardly, I would say, less than 1% cases, department would have reverted on that particular disclosure made. And in those cases, certainly the penalty, etc., in the future, if agitated by the department, could be saved. Then no penalty can be imposed in the initial year of implementation of the new law. I would say view of these natures have been taken in the service tax law when it was initially introduced. The same views are going to be there in the GST law also, where there have been so many amendment in the law, confusion, portal error, etc. So there penalty cannot be imposed in the initial year of implementation of the law. If a person is acting as per the past practice, and where the past practice has not been questioned by the department, and in the in that case in the future, if it is held to be that that practice is not correct, there also a lenient view has to be taken. Penalty cannot be imposed because itself it was admitted by the department as correct practice for the past period. So next slide, Arjun. Then we have already discussed no penalty for conflicting or divergent decision. Then this is very important point, that penalty as per the law operating on the date of wrongful act. So it should not, many times it happens that when the offense was committed, or where the non-payment of tax, it pertains to a particular year, and that point of time the penalty provisions were different, but the show cause notice issued after 4 years, at that point of time penalty provisions are different. So in that situation, which penalty provision would be applicable? So Article 20 of the Constitution of India specifically provides, and in case of PV Mohammed Barame, Supreme Court has also held that the penalty provision has to be seen on the date of commission of the wrongful act. It cannot be on the date of issuance of the show cause notice or adjudication. Then if there is retrospective amendment in the law, there cannot be any penalty, because retrospective amendment itself indicates that there was any confusion in the law, which is sought to be corrected by the government by way of retrospective amendment. One can refer to Rama Vision Limited judgment of the Supreme Court. SCN to indicate that penalty imposable. So unlike what we had discussed for the interest liability where it is self-assessed, but if there is any imposition of penalty required, so let us say in the GSTR 3B tax liability has been declared or input tax credit has been taken wrongly, but subsequently department alleges that this input tax credit is wrong, but they fail to provide for the penalty in the show cause notice. So if they fails to provide for the allege for the penalty in the show cause notice, in that situation penalty cannot be levied. Then one very important aspect is tax collected but not paid. So if one looks at section 73 subsection 11 vis-a-vis in subsection 122 penalty provision and section 132 prosecution provision, in both those penalty and prosecution provision provides that if the tax is collected and which is not paid within a period of 3 months, so in that situation the tax there would be 100% penalty, and if the amount exceed beyond the 2 crore limit or 5 crore limit, depending on that particular thing, there could be prosecution proceeding. Now the question arises, what does this word collect means? Merely charging on the invoice and not paying by the customer, would it fall in the meaning of the collect or it will not fall? Specifically when we look at like time of supply provisions which triggers charge on the date of time of supply, can that charge be said to be collection of tax also? So if one looks at Article 265 of the Constitution, there the collection has been interpreted that physical realization of the tax which is levied or imposed in case of Somia Organics judgment by the Honorable Supreme Court. So the same proposition could be applicable on GST also, where if the tax has been, money has been actually collected by the supplier and if not paid within the time limit, in those cases only that penalty could be imposed. Mere charging on the invoice cannot impose penalty under that provision of more than 3 months or the prosecution proceeding under section 132. Moving to the next slide, some more aspect on the penalty. So how can we mitigate the penalty? So some of the aspect we have certainly discussed, that disclosure is the best weapon available before the SSC. Wherever in the doubt, it should be adequately disclosed to the department. Then this disclosure, as we discussed, need not to be only what is provided in the law, it can be beyond that also. In section 73-74, there are the various stages of penalty, where if under 73, if the tax along with interest is paid before issuance of show cause notice or within 30 days of show cause notice, there cannot be any penalty. Similarly, under section 74, there are various stages of 15%, 25%, 50%, depending on the stage at which tax along with the interest is paid. So it is a situation one has to always look at whether their case is genuine or there are the reasonable ground of defending the case. If there are not I would say strong ground to defend the case, one could always avail the option given under section 73 and 74, pay the taxes along with the reduced or no penalty to avoid the burnt of the 100% penalty. Certainly classification, exemption or ITC in this side also, there has to be always backup to establish the basis on which particular decision has been taken if one want to mitigate the penalty. Moving to the some more aspect of the penalty in the subsequent slides. If we broadly look at where the provision under the law provides for penalty, section 73-74 we have already discussed. Section 122, this is the primarily section which deals with the penalty provision. Subsection 1, when we look at it, is penalty on the taxable person. So whether I am registered or not, if the offence stipulated under section 122 are committed, there would be penalty liability, and all the offence under section 122 are in the nature of mens rea with an intent to evade the tax. So all the cases of clandestine removal of the goods or the bogus invoicing or the fraudulent input tax credit, fraudulent refund, etc., are covered in the subsection 1. Subsection 1 capital A, this has been new section introduced in the current Finance Act, where it has been introduced to cover those cases where a person is mastermind for the bogus bills, etc. So if a person has created various companies in the name of like driver, cook or other servants, and he is the beneficiary, so the earlier provision in the law failed to cover such type of person. So in that situation, what the now law has provided, that where any person has committed these offences through somebody else and who is retaining the benefit arising out of that, so in that situation, that person would also be liable to penalty. This penalty under subsection 1, which is on the taxable person, and subsection 1A, which is on the person who is mastermind behind this, there could be simultaneous imposition of penalty on both the person, because it cannot be said to be hit by the Article 20, because the penalty is imposed on two persons separately for the offence committed by them. Subsection 2 is somewhat similar to section 73, 74. Subsection 3, it is applicable to any person who is aiding or abetting in commissioning the offence, which primarily include transporter or etc. So if one looks at subsection 1, it provides for penalty equivalent to tax amount evaded or 10,000 rupees, whichever is higher, whereas subsection 3 provides for 25,000 rupees of penalty. So one has to establish that there was no mens rea in order to come out the glitches of the penalty under subsection 1. Then subsection 123 to 125 provides for various other fines and penalty. 126 is certainly a very good section under the law, where general disciplines have been provided, so that there is no attempt by the department to unnecessary proceed for the imposition of penalty. It is somewhat discipline imposed for the department officer. Section 127, it provides for order for penalty. This is also very relevant to understand. Order for penalty means any of the offences what are there in the section 122, etc. And where the notice is not issued under section 73, 74 and any other proceeding, their department can issue, or proper officer can issue the order under section 127 for imposition of penalty. So this is an alternative route given for the imposition of penalty. All these penalty provisions are there in the section itself, which one can refer. These are given here for the purpose of illustration. Certainly, if you will have doubt in any of the specific penalty related offense, that you can ask in the course of discussion. So with this, I hand it over to Mr. Sudhir for giving his input on the penalty related aspect. Thereafter, we will briefly touch on the recovery aspect also. Yes, Sudhir.
Yeah, thank you, Ashish. Again, well covered. Nothing more for me to look at. One of the things which was being talked about, one more thought process which I wanted to give. Ashish posed a question saying that if I have charged in the invoice, will that amount to collection, or it has to be actually collected? So one thing you also have to keep in mind is there is something called as a cum tax. Wherever, say for example, 1,18,000 has been realized and an on-account payment of 50,000 rupees has been given, then it is been deemed to be whatever 50 into 18 divided by 118 is deemed to have been received to that extent. So that may have some challenges, is what you have to look at, unless until you will be able to get a advice for the receipt by the customer saying that against this invoice, against the basic amount 50,000 is what I am paying, 1 lakh is what I am paying, 18,000 is still not paid, GST is not paid. If you are able to do that, then it is easy for you to come out of it. So that is something which I thought as far as penalty adding. And yes, as Ashish has told, penalty has to be looked into two aspects. One aspect is that you have to look at having this as a mandatory related things wherever there is a mens rea. So 122 1 whatever has been there, everywhere the mens rea is required. 122 2 also requires a mens rea very clearly for the second clause, because the reference made is that by means of fraud, misful representation, suppression and all, where 100% penalty is required. So what is automatic is that you don't have any mens rea at all. then also the 10% penalty may become automatic, unless until you can prove that something which is beyond what you are not able to do, beyond that is beyond your control, you are forced to pay that lesser amount. Then in such case you can plead for non application of penalty, otherwise you have to do it. So these are the 2 points, and I'll add further later. Ashish, you can proceed.
Yeah. So thanks, Sudhir. So now we will discuss on the some of the final aspect of recovery provision under the GST law. So if we look at recovery, when does the stage of recovery arise? This is the first and fundamental question what has been going on in the GST, where department is trying to recover the amount by way of provisional attachment of the bank account or issuing the garnishee order to the debtors, etc. So the first question arises, when can that recovery proceeding be initiated? So this recovery proceeding start with section 78. So where the section 78 provides that department can any amount payable by a taxable person in pursuance of an order passed under this act shall be paid by such person within a period of 3 months from the date of passing of the order. If it is not paid, then recovery proceeding shall be initiated. So the recovery proceeding ideally can be initiated once a person has exhausted all the remedies available with him and charge has been affixed against him. So long as there is time limit available for filing the appeal, there cannot be recovery proceeding. Unless there is show cause notice or matter is not adjudicated, there cannot be recovery proceeding. Exception to this, we have discussed this that in case of self-assessed tax liability, there could be direct recovery proceeding by the department. Arjun, let us move to next slide. So these are the various provisions which we are not going to discuss one by one. Let us discuss some of the principles. So in the erstwhile law, it has been held in case of various judgment, like one of the leading judgment in case of Dharmpal Satyapal, that SCN has to be issued before the recovery order. Then the question arises, recovery of the tax dues. What is the meaning of tax dues? This gains the relevance in the context of section 81 also, which provides for transfer of property to be void in certain cases, where it says that where a person, where any amount has become due from him, and where a person creates charge or parts with property belonging to him in his possession, in that situation the transfer of property would be void. Now a question could arise, let us say there is some supply on which a person was of the understanding that person was of the understanding that it is not liable to GST, and on that understanding GST was not paid. Subsequently, it is held by the department that it is liable to GST. And in the course of department audit proceeding, etc., that immovable property, what is held by that person, movable or immovable, that property is transferred by that person. So in that situation, can it be said that amount has become due from him and the transfer of property is void in such cases? So here in the context of income tax, one could look at the judgment of, I would say not in the case of income tax under this SEBI, where this Harshad Mehta, this famous case of share market fraud, where it has been held that tax due usually refers to an ascertained liability. However, the meaning of word tax dues will ultimately depend upon the context in which these words are used. So once it is held that let us say that exemption is not available in some other party case, so the levy itself get triggered and the department is initiating proceeding against me, and in the course of that proceeding initiated before the show cause notice, etc., that property is transferred. So in that situation, can it be said that levy has triggered, so amount has become due? So in that situation, the transfer of property is void. So here that cannot be taken a view, that proposition cannot hold good, because tax due here has to be interpreted that tax due pursuant to order passed by the competent authority. Merely the levy does not mean that the tax due has arisen and that property cannot be transferred. Then certainly the question arises whether the recovery can be made from the property of the successor. So in case of the service care judgment, Madras High Court, there was a company which was owned by the a person, and there was another, I would say, sorry, a proprietorship firm owned by a person and another company owned by the same person. That person died in individual capacity. Department initiated the recovery proceeding against the debtor of that company. So there it was held that recovery cannot be made from the debtor of the successor or debtor of other group companies. It has to be made from the person who owes that money to the person who has not paid taxes to the government. So it cannot be that it cannot be possible that garnishee order is issued against any person. Moving to some of the other aspect of the recovery proceeding, in one of the judgment under the GST law in case of Kabir Realty Private Limited, where the Honorable Madhya Pradesh High Court has held that filing of GSTR1, what we had discussed, that in case of self-assessed tax liability, direct recovery can be possible. But here in this case, that assessee had declared the tax liability in GSTR1, but he did not file the GSTR3B. So question came before the High Court whether direct recovery can be proceeding. Direct recovery proceeding can be initiated. The view was taken by the High Court that once the supply is declared under GSTR1 under section 37, it becomes self-assessed. With due respect, it appears that High Court has failed to take cognizance of section 39, which read with section 60, which provides for self-assessment has to be under section 39 only, which is by way of 3B. So merely filing of GSTR1 cannot entitle department to initiate direct recovery proceeding. It has to be adjudicated through the process of the law. So this is certainly one aspect where one have to be careful, because department can initiate the proceeding by citing this judgment based on the GSTR1, even if there is no assessment made under GSTR3B. Moving ahead to some more aspect of recovery proceeding. So when till now what we have discussed, that recovery can be initiated only after adjudication, but the concept of provisional recovery under section 83, it is exception to adjudication, where it provides that even before the adjudication, where the commissioner is of the opinion that there could be loss of revenue or the person could run away, or in these cases he can order for provisional attachment of the property. So here the question comes, to what extent the commissioner has to satisfy himself. In case of Pranit Hem Desai, Gujarat High Court, it has been held that this provisional recovery, it is, though it is said that commissioner may, but this may has to be interpreted in such a way that he has to establish the reason to believe which has led him to order for the provisional recovery. And when one looks at the section 67 etc., which provide for inspection, the grounds what are to be invoked for section 67, those grounds are not sufficient for invoking the I would say provisional recovery under 83. So just to, I would say, further simplify it, if department feels that a person has secreted any document or records etc., they can initiate the proceeding under section 67 based on the reason to believe. But those reasons to believe cannot be sufficient to proceed for the provisional recovery. The officer commissioner has to establish beyond that the substance or the reason where he believes that there could be possibility of a person running away. So the ground what he has to establish for the ordering provisional recovery under 83 has to be on the strong footing compared to that under section 67. Certainly primarily the attachment has to be for immobile property, so that there is no jeopardy to the continuation of the business. Moving further to some of the more aspect, this slide can be skipped, Arjun. This next slide. Yeah, so liability in case of transfer of business. So there is specific provision under section 85 which provides for liability of transferor and transferee in case of transfer of business. So there the question arises, many times there are sale of the asset, whether it could be said to be transfer of business. So these provisions are relatively new under the GST. So under income tax, under the similar provisions, it has been held that itemized sale of asset or transfer of asset cannot be said to be equivalent to transfer of business. Transfer of business is more than summation of the asset. So if unless it is established that there is transfer of business, there cannot be liability on the transferee on account of non-payment of tax by the transferor. Some of more aspect without going through the PPT, if I wish to explain under the recovery proceeding, is the liability of director under the GST. So when one looks at the pre-GST regime, in those cases it has been held that there cannot be any liability on the director. There cannot be any recovery from the property of the director for non-payment of tax by the company because there were no specific provision under the law. However, in exceptional cases, the corporate wheel has been ordered to be lifted, whereby wherever it was found that the company was created for the fraud by the director, and in those cases, the liability was ordered to be recovered from the director. But when one looks in the GST law, there is specific provision under section 88 which provides that in case of companies under liquidation, if the property or if the tax liability cannot be recovered from the director, tax liability cannot be recovered from the company, in those situations the liability can be recovered from the director unless the director established that there was no misfeasance or gross negligence or breach of trust on the part of director. This talks about in case of companies in the liquidation. There is another provision which provides for the liability of director even in case of continuation of the company. So if a company is continuing and a company is not able to pay its tax liability, so in that situation the section 89 provides that notwithstanding, I would say subject to provision of section Companies Act, or I would say it is overriding the Companies Act, that notwithstanding anything provided in the Companies Act, the liability can be recovered from the director. So here one has to see in the context of IBC provision, where the Insolvency and Bankruptcy Code provide that the dues of the government are not at the, I would say, superior footing. Those comes in the 5th rank. So in that situation, if government dues are not recovered in the IBC proceeding, whether in those cases the recovery can be initiated against the director. So because the section 89 is not subject to it is not subject to IBC, and IBC provision has overriding effect, there could be liability on the director even if that recovery is not made from the IBC in view of the specific provision under section 89. The director has to establish that there was no gross negligence or misfeasance on his part if he wants to overcome his liability for the non-payment of tax by the companies. So here there is a fundamental shift on the director's liability in the GST regime vis-a-vis pre-GST regime, where earlier it was not possible to invoke the recovery against director, but under the GST law it has been made somewhat similar to provisions of Income Tax Act, and the liability specific provision has been provided for the liability on the directors. There are few other aspects of recovery, but in view of the limited times available, I am stopping my discussion on the recovery aspect. Let us invite expert comments from the SUDHIR. Any question we can take up, PPT would be shared wherein other aspect could be referred to by you. Yes, SUDHIR.
Yeah, Ashish. Few points which I wanted to emphasize on recovery and provisional attachment. Both has to happen following the due course of natural justice. Wherever there is an violation of that, something you could look at challenging the same. Sale of asset, there is a protection for the bona fide buyer. So many of the cases there is distress sale which happen. So one of the manufacturer is selling of is machinery or stock or raw material, something he is selling off for a offer price, and you may go and you don't even know the background that there was a ongoing case. The case has been concluded against this particular person. All those things you would never know. So when you have made a bona fide purchase, there is a protection for you is under the law. This is something which I wanted to bring out. Directors' personal liability. Directors are also having a personal liability if at all he has done certain activity of abating and things like that. In addition to imposing a penalty on the company, they will also impose a penalty under the directors. So once by chance the director loses in appeal, or whatever, he don't want to go for an appeal or loses the case, he accepts the liability there. To the extent of his liability, his personal asset can be touched. That's not a problem. But to the extent of the company's asset, whether his personal asset can be touched or not, has to be looked at on a case-to-case basis, like what very clearly told by Ashish, that you have to look at whether there was a malified intention and they purposefully wanted the to avoid making the payment of tax and lifting of corporate wealth. So these are the few points on recovery which I wanted to add. So with this, we have another 10 minutes or 9 minutes left. We can take a couple of questions possible in this time. If not, we will send you an email on the answers for the question. Arjun, over to you to moderate the question.
Yes, sir. So now I will read out the questions which would be answered by Ashish sir, and you can add upon the.
Sure.
Yes, sir. The first query, sir, it is in relation to interest on non-payment to supply within 180 days. Sir, just how we have discussed on the 24% interest applicability because of non-implementation of GSTR 2 and 3, can we take the same stand even for this reversal for 180 days? Since I have not accepted the input tax credit by accepting from GSTR 2 and setting off my liability by 3, can I negate the interest liability in that case?
So if I answer this question, first question could arise whether there is interest liability at all. Second question, if yes, then what is the interest liability? So if I answer the second question first, this interest liability, there cannot be interest liability of 24% in view of the various discussion what we had made earlier. In fact, this 24% interest liability, that is not applicable in any instances as of now in view of that provision of GSTR 2, GSTR 3 not being there. And when we look at section 16, which provides for applicable interest, so that applicable interest has to be seen in the context of section 50 only. So the highest interest liability, if any, can be 18%. That is the answer to the second question. If I look at the answer to the first question, whether there is any interest liability at all or not. So here it would be difficult to say that there is no interest liability, but certainly one could take a technical ground to say that once the tax has been paid by the supplier to the government, so the interest what is provided under section 50, which arises on the tax dues, and there are no tax dues pending to the government, so there is no interest liability, but that is a technical ground and which has to be tested in the court of law. So as far as the rate is concerned, yes, rate would be 18% only, not 24%.
Okay, sir. Sudhir sir, anything to add upon?
Nothing more to add from my side. In addition to whatever he has told, I completely agree with Ashish. In addition, wherever that you have not utilized, that could be the additional ground also. 180 days you have taken the credit, not paid to the vendor, and you have also not utilized. To that extent, the credit was eligible for you throughout that 6 months. That could be an additional ground for fighting.
Okay, sir. So moving on to next query. Sir, as in your deliberation, you have stressed upon that double GO party, Article 20, that no duplication of penalty cannot be applied for single offence. So in case of e-way bill violation, presently the tax officer is levying even tax under section 129, and subsequently, I have to pay the tax even on 3B. Is there any option, same like for penalty, can I say that 2 times there cannot be a levy for same transaction and avoid payment of tax in 3B?
Yeah, so what I understand, this aspect was covered by the Anil in his session, but nevertheless I am reiterating, we are of the clear view that there cannot be 2 levy on the same supply. So once the tax has been declared on the invoice and tax has been paid by the assessee, there cannot be again imposition of tax liability under section 129. So if one pays the tax and penalty under section 129 for release of the goods, there should be permission of adjustment of the tax paid in GST R3B, and in our view there is no requirement of repeat or double payment of tax liability, because without a supply there cannot be I would say imposition of tax on the same supply merely because not having the documentation. Sudhir can give his views.
Yeah, I agree with you. Nothing more to add.
Okay, sir. So moving on to second last question. Sir, in case of delayed receipt of refund, we covered that we have to claim interest. Is there any time limit for claiming such interest from department? Just like for refund purpose, is there any time limit even for that interest portion?
So if one looks at section 54, the section 54 starts with any person claiming refund of any tax and interest, if any paid on such tax or any other amount paid by him, may make an application before expiry of 2 years from the relevant date. So the time limit of 2 years is applicable not only for the tax amount but for the interest amount also. And
Okay,
as Sudhir said earlier, it is not automatic, it has to be applied, and once applied only then only you can get that refund.
Okay, sir. Okay.
But yeah, but no any specific time limit per se. It is earlier the better.
Okay, sir. Okay. Sir, moving on to the last query.
In fact, there is also a possibility that if that interest has not been paid within 60 days, you can also claim interest on the delayed payment of interest also.
Okay, sir. Okay.
So thereby, it is important for you to make the application at the earliest date. Today you get a refund. Make an application today or tomorrow itself. That could be either done as another refund in online, or you can make a simple letter saying that I have got this order without interest, and please let me know, or give me the interest. That also can be there, or a proper form can be, GST form can be filed. So earlier the better.
Okay. So moving to the last query for today's session. Sir, just in case of section 73, we have a time limit for 3 years to complete adjudication, and 74 we have 5 years. Is there any time limit for recovery under section 76 where I have collected but not paid the tax? So whether the department can collect irrespective of time limit, or is there any time limit even for under recovery under section 76?
So as far as section 76 is concerned, it is not specifically provided time limit, but when we look at erstwhile service tax law, there it has been held that wherever time limit is not provided, it should be considered as a reasonable time limit, and it has been interpreted that reasonable time limit has to be construed or read in line with that proviso to section 73 subsection 1. So here the law specifically does not provide the time limit, but in my view the time limit of 5 years should be applicable in these cases also. But certainly yes, department is going to take a view that there is no time limit specified in that section, so they have unlimited time available with them for recovering that amount. Sudhir, anything to add on this?
Agreeing with Ashish, but one of the things which you also keep in mind is that you have to remember this is an amount collected by you, kept by you, representing that this is the government's money. So in sum and substance, you are in custody of government's money. So whatever the department always want its money after 10 years, 15 years also. Even if you want to fight it, you are going to the appeals or tribunals or the high courts, you will be on a very, very weak footing, because you are arguing saying that I have fraudulently collected government's money, keeping with me, but I will not give to government because it is time barred. So this is something which you have to keep in mind. So thereby this is a risk. It's not as something of a tax planning or anything. You may end up paying beyond 5 years also. In practical, I'm talking about.
Okay. Sir, with this, to address the queries raised for today's session, I would thank Ashish for deliberating and providing throwing light on the topic of interest, penalty, and recoveries under GST law. And I would thank Sudhir sir for adding up values to the deliberation of Ashish sir. Thank you Ashish sir, and thank you Sudhir sir for spending your valuable time during this week for sharing your knowledge with the participants of this advanced certification course. Thank you, sir.
Thank you all for patience listening. Thank you, Arjun, for moderating. Ajay. Thank you all. Bye.
Thank you all participants for your patient listening. The updated PPT would be shared with you at the earliest. Thank you. We would meet up next weekend.